morning, everyone. Thank you, Felicia, for that wonderful introduction. It was way too long. It's a pleasure to have all of you here, and I really appreciate the attendance and participation in what is a really important moment. And it's been a journey, really, that we are kind of culminating here in terms of the digital journey that Ginnie Mae has been undergoing, and we're excited to share that with so many folks from the industry that are here that we consider leaders and trailblazers, honestly, that have really led the way in the mortgage industry on digital. So good morning. I'll start. It is a pleasure to welcome you, and this is the Digital Innovation in the Mortgage Industry event. So if you thought you were somewhere else, you should log off now. We have a great audience here, small and intimate, and we have a really good audience online watching this webcast, and we will also have it available afterwards as a recording. So keep that in mind in everything that you say today. This is a critical topic for our industry. I'm confident today that you're going to really get a rich experience and a wealth of information from our panelists and really just valuable insights on how important digital innovation is to our lenders, to borrowers, and other industry stakeholders, and how important the government's programs stepping up and being part of that is as well to so many underserved communities around the country. So I have the honor and privilege of being the president of Ginnie Mae. I take great pride in this and the unique and essential role that we play as a government corporation that supports and sustains financing for and affordable housing for millions of Americans. As you know, we provide a full faith and credit guarantee of the U.S. government on mortgage-backed securities that are collateralized by federally insured and guaranteed loans through the Federal Housing Administration, USDA Rural Development, Veterans Affairs, and HUD's Office of Public and Indian Housing. Our government guarantee attracts investors from across the globe and ensures that lenders have liquidity to make more loans to low and moderate income households, to our veterans, to our rural and tribal home buyers all across America, and ensuring that we can channel global capital into the nation's housing markets. In doing so, Ginnie Mae securities multiply the impact. So we are really a scaling engine. We enable the ability for folks to scale and offer more of the government lending products across America. In FY22, Ginnie Mae supported more than 2.3 million households. We issued over $653 billion in MBS and reached a historic high of almost $2.3 trillion in total outstanding mortgage-backed securities. It is because of the critically important role that we play in the market and the housing finance sector that we have a responsibility to make sure that we are adapting and rapidly changing and staying on pace with technology, evolution, and 21st century global economy and lead the industry forward in this way. Ginnie Mae has invested in transformational technology over the years to ensure that our mortgage-backed securities ecosystem is efficient and effective, and you'll hear a lot more about that. Throughout 2022 and through the year, Ginnie underwent a significant modernization effort to incorporate state-of-the-art technology that helps increase efficiency and resilience, improve access for borrowers, and lower costs. You'll hear a lot more about that today as well. Our major initiatives include the digitalization of our platform and migration to the cloud, and the growth of our digital collateral program. This technological transformation and digital innovation has been critical to creating a more nimble organization in support of our core mission and objectives as part of HUD's 5-year strategic plan to promote homeownership and create more accessible and inclusive housing finance system. Today, we have an exciting agenda. We'll hear from some of the most respected thought leaders in the field on digital innovation in the mortgage industry, including the latest trends and innovations, legal and regulatory requirements, business processes, and consumer preferences in this space. As the mortgage industry more widely embraces digital innovation, the mortgage process will become faster, easier, more transparent, and more affordable for both lenders and borrowers, strengthening the housing market as a whole. Lenders are already adopting digital tools and reducing costs, expanding access and improving efficiency and transparency for borrowers. Online mortgage applications, digital mortgage portals, electronic document signing, electronic and virtual closings, facilitated by remote online notarization, allow borrowers to access lending from anywhere in the world at any time of day. Not only is this more convenient for borrowers, but it also helps lenders reach a wider audience, can speed up application processes and improve consumer trust and loyalty. It's really crucial to us that our government programs are part of that efficiency. Automation and artificial intelligence can streamline and speed up documentation, review and approval processes, and even underwriting decisions, which I'm sure we'll hear a little bit more about today. It also improves accuracy, reduces paperwork and costs for both borrowers and lenders, and potentially leads to more equitable access for everyone. Digitalization can also optimize compliance and risk management functions by enabling lenders to better track and monitor data and tools like encryption and other cybersecurity measures that can be implemented with improved data. So since we began our digital collateral program as a pilot over 2 years ago at Ginnie Mae with just 12 issuers and securitizing our first loan that was backed by an E-note just in January of 2021, we have since securitized over $21 billion in loans backed by E-notes. We were pleased with the progress and success of the original pilot with our e-issuers. We've taken great steps forward by incorporating their feedback and improvements, and we are now permitting electronic loan modifications, for example, and other revisions that we made when we rolled out our e-guide last June. At the same time, we reopened the program in June to new applicants and have since doubled its size of the e-issuer approvals and participants in the program. As you also may be aware, we've made significant advancements in replacement of our issuance system and implementation of something called the Single Family Pool Delivery Module, SFPDM, which will allow for ease and use of more transparency around our digital collateral, as well as the eventual development of many of our e-issuers have been waiting for, things like commingling of e-notes and paper notes into the same pools. We're really on target at this point for an announcement on progress on that issue later this year. Right now, SFPDM adoption is crucial for all of our issuers. So if you're out there watching, you should make sure you get yourself up and running on SFPDM. That has been a really huge, significant evolution for the Ginnie Mae platform. We also have seen really strong support, and I want to just make note of this because I think it's been significant, and you'll hear more about it today. But this process, the team at Veterans Affairs have been really committed to this digital journey and digital transformation, and they have really enabled our digital collateral portfolio to grow, essentially. Right now, most of our 70% of VA loans are part of the digital portfolio, and so this is a particular strength of the program that's really enabled the ability to serve the community of veterans and active service members that could previously not frequently access the benefits of digital collateral, which includes closing their own mortgage loans from wherever their service takes them all over the globe. So that's been a really meaningful transition and shift that we've seen with VA, and I'm sure you'll hear more about that today from the VA team. In addition, Ginnie Mae has also undergone our own digital modernization. After years of planning and executing, as I mentioned, this year we migrated to the cloud, the early 2023, full migration, and I'm really proud to say that our CIO and our team has done something that is incredibly significant, especially as a federal government agency, and you'll hear a lot more about this from Barbara Cooper-Jones, our CIO, this morning. So I'm going to close. I just want to say it's an honor to be with you. I'm very pleased that all of you are here. Thank you for your participation in the work every single day, in the innovation and leadership that you're providing, and everything that you've all accomplished together. And I'm just excited that we're able to share this with everyone today. I'm going to have an opportunity now to introduce our keynote speaker, and I'm very, very proud and just so pleased that you were able to join us today. Ramon Richards is with us. Ramon is the Chief Information Officer and Senior Vice President at Fannie Mae. Ramon, when I was at Fannie Mae, was there and has just been, watching him blaze the trail and rise up and at Fannie Mae has been just an absolute pleasure to see. And he have done some phenomenal work there. In his capacity at Fannie Mae today, he is responsible for Fannie Mae's technology assets, cybersecurity, enterprise data assets, and implementing the digital solutions that enable the business and deliver value for its customers. Ramon joined Fannie Mae in 1999. has also served in various roles within the organization. He's been Senior Vice President of Integrated Technology Solutions, Securitization and Servicing Technology, and Vice President for Securitization and Credit Technology functions at Fannie Mae. Longtime friend, someone I've admired, really happy that you're with us today, and we're really excited to hear from you, Ramon. So please come on up and join us. Thank you. Thank you.
Good morning, and thank you, President McCargo, and Ginnie Mae for the opportunity to be here today. Let me also take this opportunity to recognize Elena for her incredible leadership when she was at Fannie Mae during the Great Recession. Elena helped create and carry out the Treasury Department's Make Home Affordable program for Fannie Mae. The program helped struggling families avoid losing their homes. Those individuals may not know who Elena is, but I do, we all should, and I want to take a moment and give her a round of applause. I'd also like to acknowledge a longtime friend of mine. We were colleagues at Fannie Mae, and she is the Chief Information Officer at Ginnie Mae, Barbara Cooper-Jones. Great to see you as well. It's nice to be a part of what our industry is doing together to house our nation. So let me share a little bit about my role. As Elena had mentioned, I am Fannie Mae's Chief Information Officer. I'm responsible for our Fannie Mae's technology assets, as well as our enterprise data, cybersecurity, and then leading our delivery of digital capabilities that are enabling our business. These capabilities are focused on driving and delivering value for our lender partners and ultimately the homeowners and renters that we serve. That is the core of what we do. But we are also driving Fannie Mae's digital transformation. We are helping our business lines implement their business priorities and solutions. These are enabled by secure, scalable, resilient, and innovative technology capabilities and services. But it also boils down to enabling Fannie Mae's mission to advance equitable and sustainable access to home ownership and quality, affordable rental housing for millions of people across America. There are three main things I want to touch on today. The first is how digital transformation holds the promise of transforming the housing finance system. Next, how Fannie Mae is dedicated to solving the biggest challenges in housing. And finally, how Fannie Mae is using technology to knock down barriers to home ownership. So let's start with mortgage digital transformation. When people think about mortgage finance, they may not think of it as the center of technology innovation. That's probably because the mortgage process has been long overdue for modernization. In fact, today somewhere, someone is still using a fax machine. Anyone who has applied for a mortgage knows about the stack of paper documents that are involved in it. It makes no sense today when most everything else is digital. But housing finance is finally easing into the digital age. And our digital transformation is driving our ability to offer solutions to America's biggest housing challenges. As you are all probably aware, we are no stranger to mortgage technology innovation. It is hard to believe Fannie Mae launched our desktop underwriter system almost 35 years ago. And 35 years later, we are fortunate that our lender customers are still making Desktop Underwriter the leading automated underwriting engine in the industry. That's what continuous improvement does. Turning to Fannie Mae's role in mortgage digital transformation, we are always looking for ways to improve the mortgage process to help make it safer, simpler, and less expensive. One example is our responsible during the early months of the pandemic. Our digital transformation was at the center of our response to supporting homeowners and renters experiencing financial hardship. For instance, we rolled out a forbearance relief tool that helped more than 650 multifamily properties potentially impacted by COVID. We also rapidly rolled out mortgage forbearance options to help homeowners who were falling behind on their payments. And we quickly set up a new payment deferral workout option. Our continuing ability to leverage technology as an enabler to help meet the changing needs of homeowners and renters directly improves on our capacity to fulfill our mission. We are improving our daily work by finding ways to simplify, automate, and eliminate unnecessary processes. One way is through what we call our exit analysis tool, which helps to analyze and forecast the likelihood of loan defaults. As a result, we've improved the quality and speed of the multifamily loan decisioning process from 16 hours to 6.5 hours, saving our underwriters over 2,500 hours every year. We are also looking at ways to improve data accuracy and security of data captured by third-party inspectors engaged by multifamily lenders. We created a standard method for creating data called the Delegated Underwriting and Servicing Data Digitizer. The platform allows us to automatically capture nearly 96% of inspectors' due diligence reports. This is transforming core parts of our multifamily business and delivering innovations that will drive positive change. We will continue to focus on new, innovative services that deliver value for renters and homeowners and position Fannie Mae as a housing leader and helping more people throughout their path to homeownership. More than those things, Fannie Mae is leveraging technology to help advance equitable access to housing responsibly. We want a housing finance system where all people, including those of modest means, have access to quality, affordable housing options. We are also working to knock down the barriers to affordable rental housing and homeownership for historically underserved populations. Data can help us advance this mission by expanding both education and access for these populations. We do this by better educating renters and homeowners through resources like HomeView. This is Fannie Mae's free online homeownership education course that helps consumers navigate the mortgage and homebuyers process, and it uses data and cloud computing to better educate potential new homeowners. Fannie Mae plans to use cloud computing to better serve underrepresented and disadvantaged consumers. We are also helping to reduce costs in the home buying process through digitization and efficiencies. And we're enhancing our desktop underwriting system to help responsibly expand mortgage eligibility. Fannie Mae has clear priorities for inclusion, and they drive every aspect of our work. One way is through promoting sustainable homeownership, which has been a major driver of generational wealth throughout our nation's history. We believe that addressing racial inequities in housing will help make our nation more prosperous by allowing more people of color to build generational wealth and economic stability. Fannie Mae is working to help protect mortgage practices from both intended and unintended discrimination, and we make fair lending a top priority. We look at home ownership as a journey and affordable rental housing as part of that journey. We are working to scale our business model to help create and preserve affordable rental housing so that more families of modest means have options to live in communities with more opportunity. Fannie Mae has taken solid initial steps and laid the groundwork to do more. We are focusing our efforts on three principal areas. Consumer empowerment, where we are helping expand homeownership and rental opportunities for underserved communities through inclusive housing education and products like HomeView that I mentioned earlier. Next, a representative workforce. As we commit to diversity in our company, we're helping to support an industry workforce that reflects our diverse nation and helps drive equitable access to housing, and moving our housing mission forward. Fannie Mae today continues to advance our mission with our Equitable Housing Finance Plan, an actionable 3-year roadmap designed to overcome inequities in the nation's housing market. We introduced our Equitable Housing Finance Plan last year and issued an update late last month. The plan is the latest piece in our much larger and evolving strategy to address inequities in the housing finance system and extend the wealth building benefits of homeownership. This is a long-term commitment, one that we realized wasn't going to happen overnight. The 3-year plan is an essential part of Fannie Mae's mission, and our strategic business priorities. It is also a core reflection of our corporate values. A good example from the plan is our positive rent payment history initiative. It is a prime example of the potential of using technology and data to help remove systemic credit barriers to mortgage finance. In a nutshell, the update in the desktop underwriter enables lenders with permission from mortgage applicants to automatically identify recurring rent payments in the applicant's bank statement data to deliver more inclusive credit assessment, even if those positive payments do not appear on their credit report. Because we believe if people consistently pay their rent each month, they are likely to pay their mortgage consistently too. From a digital perspective, this was not a simple challenge. First, we had to leverage a new data source, the loan applicant's bank statements. Second, we had to make the new data source usable for our production systems. For this, we use machine learning to develop algorithms that use bank statements to identify rent payments. Now, some renters who may have been denied in the past may be qualified to become homeowners, all by leveraging the power of data. We believe this change will allow more renters, aspiring first-time homeowners, to responsibly qualify for a mortgage from their lender, including those with limited credit history. In fact, it's already happening. Since we launched the plan in September 2021, about 3,400 mortgage applicants were eligible for loan approval because of their positive rent history. Roughly 50% of those borrowers identified as minorities, and 41% identified specifically as Black or Latino. Looking ahead, the key to helping us deliver on our mission is to keep pace with the changing digital landscape. To that end, I am very excited about the potential for the cloud to advance our transformation and our role in modernizing the mortgage finance system. The cloud offers opportunities to advance our business data and data security and enables the modernization and transformation of critical business processes. The cloud technical capabilities are driving the process by creating faster credit review times, quicker identification of potential risk, and faster delivery of time to market. Momentum is building, and other players in the ecosystem are moving fast. For us to continue to lead, we are carefully exploring new ways to use technology to help improve the mortgage process even further and advance the housing system. Many business functions are ripe for technology innovation. We've been working closely with FHFA's new Office of Financial Technology in support of FHFA's priorities to the adoption and deployment of mortgage-related fintech and innovation. So to wrap up, we recognize that the world around us is changing, adapting, and automating in numerous ways. We are creating new products and services for lenders and consumers as we work to achieve the promise of a shared vision of housing the nation. And the innovations have the potential to make a huge difference in how many individuals we can serve on our mission. The mission, as I said earlier, is to facilitate equitable and sustainable access to home ownership and quality, affordable rental housing across the nation. This truly remains at the core of everything we do. I am excited about the next horizon for the housing finance system and the digital transformation steps that Fannie Mae, Ginnie Mae, and many others are taking for the purpose of serving people who need housing in their communities. As an industry, we've come a long way since Elena and Barbara were at Fannie Mae, using the technology available then to put people into homes and help them stay there. The technology we used back then certainly has evolved dramatically. There are great new technologies on the horizon, technologies such as AI, to machine learning, to blockchain, and more. We need to harness new technologies to responsibly carry out our mission, but technology is just a tool. Most of all, we need vision, passion, and determination to create and harness technology that constantly serves the nation's housing needs even better. The kind of vision, passion, and determination that Elena and Barbara bring to Ginnie Mae, and that we strive to bring to Fannie Mae every day. Thank you again for your time.
I now have a great opportunity, and it is my pleasure to introduce our next speaker. And she will address the Ginnie Mae transformation journey and digital here at Ginnie Mae. She is our CIO, award-winning CIO, Barbara Cooper-Jones. She is the Senior Vice President of the Office of Enterprise Data and Technology Solutions, and as I mentioned, our CIO. She is responsible for defining and developing enterprise-wide strategies to ensure the ongoing and future alignment of Ginnie Mae's operations and technology across the enterprise model. Prior to joining Ginnie Mae in 2011, Barbara was Assistant Vice President at the Federal Reserve Bank of Richmond and Vice President of Enterprise Data Technology at Fannie Mae, as was discussed, and had many other leadership roles in the industry. She brings more than 25 years of experience in transforming information management environments and building long-term partnerships with business and technology stakeholders. She has been a leader and an inspiration for all of us at Ginnie Mae, and she is truly the leader who got us on, transformed us and migrated us to the cloud, and that truly is making us more nimble and a better Ginnie Mae. Barbara Cooper-Jones.
Thank you. Good morning. I will try not to repeat anything on the cloud that Ramon has said. He probably saw my talking point. But it is a pleasure to be with all of you today. Ramon, I consider you a trusted colleague and friend. You shared some recent good advice. I'm going to adhere to that advice. I will say this, when I was at Fannie, I was not the CIO. When I was at Fannie, I didn't win any awards, so that is reserved for you. So again, my pleasure to be with you today. For the past 11 years, as Felicia has said, I have had the honor, really, and the privilege to lead Ginnie Mae's data, technology, platform operations, modernization and transformation program, IT governance, and information security. Lots of parallels. Our CIO program really is in my opinion, a good place. And with a continued investment in people, process, and technology, I candidly believe that it will be in a great place. And so my goal this morning is to share some of our planned efforts and help you understand the business value of what we are trying to accomplish as we deliver to our ecosystem. I'm going to start by sharing just a short and concise definition of what digital transformation means at Ginnie Mae. And digital transformation means to leverage or harness technology and its connectivity to our existing and hopefully potentially new ecosystem partners. That's what digital transformation means to us. So I want to give a shout out to Lynn Chandler. President Elena McCargo mentioned our digital collateral, our e-mortgage program. And I just want to share, I know Dave Coleman is in the audience. When I would attend the MBA tech conferences in the recent past, many years ago, I would get pulled off to the side and not publicly ask, but privately ask, when is Ginnie Mae going to start to accept e-notes? And so when I would go to the MBA conference, I would start to duck this individual who would pull me to the side and ask me the same question, because then I did not have a good response to that person. Well, when I go to the MBA conference now, I go very boldly, and no one pulls me to the side. And so I really want to thank Lynn Chandler and her efforts and the entire eMortgage digital collateral team. They've done some phenomenal work, and more importantly, what they've done is harness technology and connectivity to deliver greater value to the ecosystem that President Elena referenced this morning. So our innovation over the past several years was really focused on probably three things. The first one was to ensure that we had an enhanced user experience. And we did that in a number of initiatives, our loan level disclosures, the back office work that we were doing to enhance our securitization processing operations, and really more digital innovation across the entire application landscape, what we would call a modernization program solutions delivery. The second piece of innovation really was focused on data as a service and providing the analytics and the capabilities so that we could get the right data to the right people and at the right time, and to be able to respond to their vastly different needs for having data and to be able to have that evidence-based decision-making. And then the third thing was focused on, quite frankly, putting some building blocks and pillars in place so that we could do broader transformation. And so we did that in very strategic sets of goals and objectives. And that laid the foundation for our first cloud migration to a public cloud many years ago. And you don't hear as much about that migration because, quite frankly, it wasn't all that we had hoped and expected it to be. We went to a public cloud. However, we had challenges. We had challenges with resiliency. We had challenges with reliability. We had challenges with stability. We had all kinds of challenges. And, we said, we've got to have a bit of a cultural shift here. We are used to having several on-site data centers, on-premise data centers, and now we're in a cloud with 40 other tenants. We just can't have it our way whenever we want to have it our way. But my chief technology architect and I just had a very heart-to-heart conversation one day, and I just asked him, do you sleep well at night, given that we are in this cloud? And he said no. I said, well, let me tell you, I don't sleep well at night either. And so what we did is we planned another strategic set of objectives, and that was to move to a more mature cloud. We went to our executive operating committee, and we said, these are the challenges that we're having. We have put a stability plan in place. There has been a good response by the vendor to this plan, but we do not feel comfortable migrating Ginnie Mae's securitization platform, our MBS platform, which means a lot to us. We do not feel comfortable moving it to this cloud. And so we will look to a more mature cloud provider. We will learn from this experience, and then we will plan a better path forward. And so we went to our executive operating committee, our EOC. We put that plan forward to them. They approved that plan, and we moved in that direction. And so, as President Elena said, this past October of 2022, we completed our final migration to a more mature cloud. And I can tell you there had been no better execution of anything I've seen, even though Felicia said 25 years is actually much longer than that. But it was a tremendous success. And so now that we are in a more mature cloud, business transformation now is the broader goal. And to be honest with you, we are so positioned for it now. We have the right people in place. We could certainly use more, but we have the skill set, we have the purpose, we have the commitment, and quite frankly, the full-fledged support of our front office to move our business transformation program forward. And that is the vision. So aligned with that vision, we've put some other initiatives and steps in place. We hired a cloud architect that has the cloud experience for the cloud that we are in. We have established a cloud center of excellence, and that cloud center of excellence allows us to have that small team work across Ginnie Mae to innovate and to share cloud expertise, which is important to our staff. So now that that stage has been set, we are in a mature cloud. We have a business transformation vision. The question is, what are going to be those key strategic drivers for that vision? And there are many. And one thing I want to share with you is I have another trusted colleague. He's my peer. Operations and technology are joined at the hip. And we left work one day and decided to go for a happy hour. And in the course of that happy hour, we talked about our vision for Ginnie Mae when we were gone. And I asked him, I said, well, what's your vision? He said, you know, we came in, we found the platform that needed some work, we've done some good work, but wouldn't it be nice to leave it in an even better place than it's in? And I said, absolutely. So we committed that night over a few drinks that we were going to be partners in an initiative that would potentially sustain our MBS platform for another 3 to 4 decades to come. We committed that to each other. We came back. We shared that with many within Ginnie Mae. We got their full-fledged support, and that is the direction that we are moving forward now. And so we defined some other strategic drivers other than wanting to ensure that we had a platform built on modern-day technology that would sustain Ginnie Mae for another 3 to 4 decades. We looked at product flexibility and said, you know, we need to have greater product flexibility for enhanced business agility. We needed to have more digital interoperability. Someone mentioned risk management. We needed more robust risk management across the enterprise. We needed more and stronger data decisioning capabilities. And we needed to have this workforce for the future that would work with these more sophisticated technologies. So those made up our strategic drivers for our business transformation program. And then we embarked on the Innovation Lab at Ginnie Mae, where we started to investigate and evaluate emerging technologies. We had vendors to come in, we had industry experts to come in, we talked to them, we went to seminars, we went any place that we could learn about these emerging technologies. And our Innovation Lab was supposed to be a think tank for the organization. Come and bring your ideas, come and bring your challenges. So much so that 2 years before the pandemic hit, we were already looking at virtual collaboration tools because the Office of Enterprise Risk wanted to do things differently when they were working hybrid. This was 2 years before the pandemic. And so when the month or two before formally the pandemic hit, we already had a virtual technology. We had the decisions made. We knew what support we needed. Everyone left on, I think it was March 17th. Everybody started to work from home. No one missed a beat. And people were probably even more productive because they didn't have to endure those long commutes. One of the things that I did in preparation for today is I talked to 3 of our key business areas, and I asked them, what are some of the problems you're trying to solve that I might not know about? And how can the CIO organization help you? And as you would guess, I heard some common themes, but I also heard some different things. And I'm going to share 3 different things. So first, I heard from one program office, and my peers here, my team needs to work smarter, not harder. And one of the things that we had done is we had brought in some low-code, no-code technology into the lab. We had evaluated many vendors and ultimately selected 2 or 3 of those vendors. And so she had an opportunity to say, and she had a wonderful business challenge. And what we did is we asked her to participate in the proof of concept. They're a team, and they did. And we have moved from a proof of concept to a prototype to full-fledged development. And they have been along the journey from day one, from project inception to 21 sprints. And the theme is we want to work smarter, we don't want to work harder, and give us the technology to enable us to do it so we can bring these capabilities in-house and still deliver on our compliance and monitoring work. And I applaud you, Leslie, for sharing that with me and allowing us to help you solve that business problem. A couple other themes I heard from other business partners is business agility. We absolutely need that. It takes a long time for us to implement changes in the platform we've had, even though we've modernized it and, quote, renovated it over a couple of decades, because it wasn't built on modern day technology. So the business transformation vision that we've put in place and the flexible architecture that we have defined is going to offer us business agility. Another business area said, and I want to applaud this other business area because he has embraced AI and ML probably before any other area within Ginnie Mae, our Office of Enterprise Risk that's led by our Chief Risk Officer, Greg Keefe. They even have natural language capabilities there. They even came to us with the problem, we want you to look at this solution. It's like, I've never even heard of this stuff. And I went to Gartner, didn't find very much on Gartner, but through some other sources, I found some good information, and we were able to implement a machine learning solution that allows the data to be integrated and there be narrative about the data. Adds tremendous efficiency for his staff. But one of the other things I heard from our Chief Risk Officer is I need more unstructured data. Bring that data in, integrate it with the data, and help us make some smart analysis around that data. And we will continue to do that as well. And so really the stage really has been set for a number of things. And as we continue to expand on our digital transformation work, you will see that greater value that we'll be able to deliver, not just to Ginnie Mae, but to those we serve. And Elena mentioned our single-family pool delivery, our module work. Dave Coleman, so interested in meeting and chatting with you more about that. We hope by the end of this year, as Elena said, we will have full adoption to MISMO standards. I know we are a decade and more behind Fannie in the industry. We know that. You guys have a lot more people than we do, so you could get there faster than us. But we have been fully committed to that. We have over 3,700 pools that have already been delivered through that digital submission of information. And I think it's over 21 billion of issuer and guaranteed pool information. One other low-code solution I want to talk about, and that is in our IT service management area. And for those who don't know what low-code, no-code is, it really is, it allows you to use graphical user interfaces to deliver code in sort of a metadata way so that you don't have to do all this hard coding, which programmers typically do because it takes a lot of time to do that. So low-code is much, much more efficient. But one of the things when I talked about digital transformation and connectivity, we have some low-code solutions in our customer experience area, and we have it in our IT platform cloud area. But what we don't have is the connectivity. And so that is the next thing that we're working on, is to consolidate all of this so that if anything happens on the customer experience side, there will automatically be that integration, that notification to our cloud platform people that there is something they need to pay attention to because a user is reporting it as an issue. And so we are now embarking on enterprise, IT enterprise platform operations, leveraging a low-code, no-code solution. A couple other things I want to mention, AI. How can we not get through this conference without AI? Everybody's talking about AI. And generative AI is really, really important, and I can tell you now that Ginnie Mae will be enlarging its footprint in AI. We have AI embedded in our financial operations under Toki Laufenmaken, and who is our OCFO. We have a lot of external data that comes from a master subservicer. We have context files that come in with that data. And you have to merge the context files with the other data files, and then there's some data quality issues and holes. And so a couple of years ago, they implemented an AI solution within Ops to help them understand the quality issues around the data. And it truly has improved the data quality. Getting back to AI, we have that in other pockets of the organization. On a personal note, I am a huge fan of ChatGPT. No, we do not have ChatGPT at Ginnie Mae. Do I think there will be an opportunity to have it here? Absolutely. But we're going to define an appropriate AI strategy. And I know in talking with you that you guys are going to be doing the same thing. You got to figure out where those guardrails are up front and put those guardrails in place. Interestingly enough, I was at an emerging tech conference just yesterday, and there were a number of presenters, panelists that were talking about leveraging AI to upskill their staff. Because what they've done is they've taken some lower level tasks and automated that with AI, taken that lower level task away from their humans, their staff, and allowing their staff to work on higher value tasks. So they're looking at it in terms of upskilling, in terms of knowledge management, and other areas. But it has huge, huge potential, not just at Ginnie Mae, but again, we're going to do the appropriate thing. I want to just mention data very briefly, because our data journey has been truly a journey. We have probably revised our data strategy every 2 to 3 years. And the reason we've done that, and I want to applaud my peers within the organization, they have hired different individuals that have a diverse skill set, a more sophisticated skill set, quite frankly, than some of the other people that we previously were providing data to. So they're asking for much, much more sophisticated data in a much, much more sophisticated manner. So one of the things we needed to do is we conducted this human-centered design workshop to really define what are the personas of people that we have, what are those different personas, and how do they really need to work? And once we found that out, we said, okay, we know that this group wants dashboards, so we'll give them dashboards. Someone else wants another self-service like data tool. We'll give this group that set of data tools. Somebody else needs this, someone else needs that. It's different personas. And so we will continue to evolve where we are. And so what we did over the last couple of years is we really evolved our data strategy to be more of an analytics vision and strategy. Again, getting the right data to the right people at the right time. I want to mention a couple of other things about the work that we are doing in our innovation lab and emerging tech space, and that is with blockchain. Ginnie Mae leads a consortium that's called the Federal Housing Blockchain Network, the Federal Housing Blockchain Network. And it is a forum of government and industry where we come together, we share information, brainstorm, and really talk about opportunities for the ecosystem to work closer together. And really opportunities for the mortgage stakeholders to determine where can we take the friction out of the process? Where can we make it more efficiently? And how can we leverage technology to do that? So that's what that forum is focused on. And they're going to shift, I believe, a little bit to DLT, distributed ledger technology. I know that's something that Fannie is interested in. We're looking at that as well. We have a very active proof of concept going on with DLT. One of the last things I want to mention is I spoke at a technology conference last week, and there was a future IT-ready question that I expected to be asked. And the question that I expected to be asked was, well, are you future-ready, and what does future-ready mean? And I want to share what I would have said had I been asked that question, because it's so pertinent to where we are at Ginnie Mae in our journey. And so future ready means three things. And Ramon, you hit on actually all three of them. The first one is enabling digital optimization and transformation across a number of successful initiatives and being able to measure and articulate the value of that digital investment. We are not there. You mentioned some metrics, which was powerful to me. That's where we want to be able to say, this is what we've invested, this has been the return on investment, and these have been the successful initiatives. The second one, being future IT ready, is having that cloud ready platform. The good news is we've got the infrastructure in place so that it meets those evolving needs of operations and what the business needs. And the third one you also touched upon, we're not quite ready there, and that is having this workforce of the future that has the skills, the talent, the sophistication to be able to work smarter, leveraging whether it's hyper-automation, AI, ML, distributed ledger, whatever. But I think it is incumbent upon the CIO organization to co-create opportunities with our business and to be able to deliver on these solutions. And that is something that we look forward to. And repeating one thing that one of the other SVPs shared with me is really defining the art of the possible, preconceived ideas, and making them work for Ginnie Mae. So I just want to say thank you to those in the audience and who may be on virtual communication that have paved the way for Ginnie Mae to be where it is today. I owe you, and Ginnie Mae owes you, a debt of gratitude.
Sam Valverde is my colleague and partner, and I am here to introduce him and let him introduce himself and the rest of the panel. This will be a great panel, and he is our foremost expert on ESG and many things relating to digitalization and e-mortgages.
Sure, I don't.
Okay, good.
No worries. Well, thanks a lot, Felicia, for that warm introduction. It's really great to be here and have this conversation. As I think everyone in this room has heard, the future of mortgages, digitization, automation is really critical to Ginnie Mae, especially because we are a very small team. Right? So every time we can figure out a new efficiency to leverage our human resources better, that's critically important to us. So it's not just about keeping up with the industry, but also making sure that we serve the industry as best we can, and ultimately consumers. This is a really great set of topics to talk about today. I have a really great panel to talk about some issues in the mortgage finance space. So hoping everyone can sort of introduce themselves. Colin, if you want to start, that'd be great.
Sure. Thanks to Ginnie Mae for hosting this awesome event. I am Colin Diazzo. I run data and technology for the U.S. Department of Veterans Affairs on the VA Home Loan Guarantee Program.
Mike Fratantoni, I'm Chief Economist at the Mortgage Bankers Association, and I head up our group called Research and Industry Technology.
Thank you, Sam. Thank you to the entire Ginnie Mae team. I'm Tim Bowler. I'm the President and Vice Mortgage Technology, and it's a pleasure to be here today.
Sam, thank you. I'm Dave Coleman. I am the President of BISMO, so just be easy on me because I'm about 6 weeks into my role.
And I'm Vonda Renfro. I'm Director of Collateral Management at Federal Home Loan Bank of Des Moines, but I have also served on the Keynote initiative for the whole Federal Home Loan Bank system for many years.
Great. So just a process item. We will have time for questions from the audience, both online and in person. So we welcome those. So keep thinking about what you might want to ask this group of folks. So Mike, this is a really interesting moment in the mortgage finance system, in the broader financial markets. Every week something else happens that feels more unique, more unprecedented. So how do industry leaders think about investments in innovation in that context? Is it more important than ever? Is it something we need to think about and stagger? So how are folks thinking about that?
Yeah, great question, Sam. So again, thanks for having me here, and thanks to Elena and the team. So if you look at the mortgage industry, 2020, 2021, two biggest years we've ever had, north of $4 trillion. 2022, mortgage rates doubled. Origination volume fell by half. 2023 looks like another tough year, not enough homes on the market for the buyers that are looking to buy. We're projecting another 20% decline. At the same time, volume dropping as sharp as that, we're also seeing margins contract very, very much, right? So it leads to, sort of the quip in mortgage land, right, where lenders say, I either have money that they did in 20 and 21 to invest in technology, or I have time. This year they have time, but they've got no money, right? So it's always a quandary about, when's the right time to invest in innovation. One more number that I want to share with you, because I think it's really pretty important. If you go back to 2008, our data from our Mortgage Bankers Performance Report showed it cost about $4,000 to originate a loan. Fourth quarter of 2022, it cost $12,450, right? So more than triple over that time. Lots of reasons for that, and we can dig into it, but the solution of how you at least try to cap, if not bring that number down, is to try to innovate more, get more automation into the system, make everybody more efficient. So just to sort of lay in the table for what we're going to talk about today, I think it's important to get those numbers out there.
It's really helpful. I don't know if anyone has another sort of industry perspective on the moment and the investment opportunity now.
Well, I'm Sam, I'll jump in. Once again, it's Tim Bowler from ICE. At our organization, we're redoubling our efforts to invest in technology in order to try to drive efficiencies across the mortgage ecosystem. Ultimately, we see a lot of analog processes that can be digitized. And by the way, I'm a huge fan of vinyl, so I don't mean that with all respect. But I mean, there's still so many things in across the ecosystem that could ultimately be digitized to try to drive efficiencies. I know we'll spend a lot of time talking about Keynote, Collateral, and the full electronification process. I continue to think about that within the context of how do you improve efficiencies around the front end, and then also how do you use that to improve efficiencies in the back end. Thinking about the last refinancing wave, what Mike just talked about. The fact that so many moderate to lower loan balance loans didn't refinance efficiently when they should have. A lot of that happened to be because of the difficulties in getting to those borrowers and getting them to refinance and populating a loan file efficiently. That can be all done through better digitization of these processes. So from our perspective, we plan on making material investments throughout the cycle to help try to drive innovation, try to drive lower costs, and then try to drive greater efficiencies and access to borrowers of all backgrounds.
That's great. As you know, Ginnie Mae is similarly all in on digitization, modernization, and for us, Collateral is really exciting as a risk management tool because, as we know, we don't own the underlying loan, so knowing there's integrity and ease of access to those records is really, really critical to us. Can you talk a little bit about sort of how that Collateral plays in risk management in the industry?
Well, I think there's the proactive and positive, and there's the asset value of it. So I'll start with actually the asset value first, which is more the risk management aspect, but I do want to circle back to the proactive and positive. And just think about it, if you ultimately have that collateral in digital form or electronic form, and it has to be moved because of unfortunate circumstances, there's just greater degree of efficiency and certainty associated with that. I know we'll talk a little bit about that today within the context of thinking about how you liquefy mortgage assets in the banking industry, and that's absolutely critical given everything that we've seen over the last couple months, that we need to make certain that collateral can move efficiently, whether it be to a home loan bank or whether it be to the Federal Reserve System or some other source of liquidity. Electronic notes facilitates you getting that done. Secondly, this is just absolutely a deeply passionate issue from my own perspective. Thinking about that positive window on it, I think about all those borrowers that should have refinanced through the last cycle that didn't, because they probably had a low to moderate sized loan balance. If their loan was in digital form, it would have been so much easier for the industry to work with that borrower, to work with that household, to try to find a way to populate a loan file to efficiently get them to refinance. And there could have been a deep focus from a lot of lenders that would have said, I'm going to specialize on this because I can scale that now that that collateral is in electronic form. And we would have gotten to so many millions more households that have moderate incomes or lower loan balances to refinance, relative to having that be continuously skewed towards higher loan balance borrowers. And I think that's what digitization and technology can do. So there's both the defensive associated with better management of collateral, and then there's the positive aspects associated with it, particularly around refinancing or refinancing or other opportunities that might come along for moderate to the lower income household.
That's great. Yeah, I think as a policy matter, Ginnie Mae fully agrees, right? We see digitization as a way of making those smaller loans more accessible to refinancing. At the same time, having easier access to credit. The VA has been a leader in that space. VA lenders have been leaders in that space. That's really provided a proof of concept for sort of how ease of access can really benefit consumers. And that's part of why I think this is a really important priority for us at Ginnie, because opening up the government channel to e-collateral really was that last missing piece, right? Barbara ducking questions at conferences. Like, we aren't ducking those questions anymore. We're in, and we hope that creates an opportunity for these kinds of conversations to drive ubiquity for e-mortgages so that those kinds of gains can come across the industry. I think we were probably that final missing piece, and we hope to drive that change together, working with you all. It's really helpful.
I think Tim has it right, and I often kind of use the term portability of data, and we as an industry, I think, have looked at portability of data more on the secondary and a liquidity story. I think it's interesting to explore thoughts around portability on the consumer side as well, in terms of how they manage their digital assets and their digital wallets. So I think that's probably the next conversation that the industry will have, once we figure out standards and portability and transferability of the asset and the collateral side. So that's important points.
That's great. Yeah, a lot more to do. Dave, not to be unfair because you've only been in the job for 6 weeks, but what do you think about making mandatory the use of MISMO, legal and collateral naming fields, to better drive collateral management and sort of accelerate closings?
Yeah, it's an interesting space. Good question too. It's I personally believe that by moving to a standards is good for the industry, period. So having the ability to exchange data that is defined the same way, looks the same way across transactions can be nothing but beneficial. Mandatory, though, is an interesting term because from our standpoint, we are really around coordinating the members of BISMO and of the MBA to get aligned around usage of these elements. But when it comes down to saying mandatory, that's a space that's kind of outside of my purview anyway. But I think that we're probably better situated than anyone else to help facilitate standardization of not only the data but the processes and procedures that go with that. That being said, it's one of those types of things where it's going to take the industry saying that we want standards, we want to be able to talk to one another in different systems and be totally interoperable. That is going to drive that standardization of data and technology and methods. And so it's kind of a challenge to the industry to line up and to do those types of things that make it so that it's there are so many benefits to standardization. And the thing about it is it's also a space where it's not a competitive issue when you start getting into data and packaging, especially for in the collateral space. I mean, closing package is a closing package typically, and it's not an edge that one company is going to get over another by doing it slightly differently because it is mandated. So
that's great. I don't know, Vaughn, if you have any perspectives to share.
I would. I really think the standards are important for the whole industry to make it all work together. It takes every segment of the industry to be on the same page because if we have to be concerned about a liquidity perspective. So, in the event one of our members would default, we would need to be able to sell that. So we can't can't sell it to someone that doesn't have the system and the capability to accept that collateral. So I really think standards are a key, or at least everyone, jumping in the same pool at the same time would be really nice to make the whole ecosystem work. And I want to take a chance to publicly thank ICE and Mortgage Technology for the secured party field. That helped Ginnie and the Federal Home Loan Banks step into the ecosystem. And so really,
thank you.
Now's a nice time to to say thanks for that.
And any feedback you have and any advice you have, please. Do you mind if I jump in on that?
Please.
One of the things that we've been thinking about at ICE is how we can potentially be helpful with both the private sector and the public sector around that. But at least I like to think about it as the three-step process of trying to drive improvements and change in the mortgage industry, which is, first the first phase is always the encouragement. Like, here's a better way of doing business because here's the benefits that you're going to get. Second is like here's the incentive structure, whether us as an infrastructure provider or the official sector, or with the GSEs or the agencies. Here's incentives in order to try to drive towards greater standardization or electronic collateral, and then eventually finding a way to basically put a mandate on the industry. And you have to, it's going from like zero to a mandate just never works, because one of the great benefits of the system that we have here in the United States is we have thousands of mortgage lenders, and it's great. It creates a competitive market. It creates access to liquidity. You're not just stuck, with I spent a bunch of time over in the UK and Europe, over the last 5 to 6 years. You're not just stuck with only a handful of lenders, which really restricts credit. You have a big, open, dynamic market. So you want to be able to do that. So you have to respect that process of, encourage, incent, but then ultimately you do have to reach or push for mandates in the system around standardization, or you don't get necessarily the benefits of scale in that regard. So we're thinking through that. There's on things that we can do, particularly around that incentive structure, around trying to help drive standardization down the road, and hopefully more to come on that in the near future.
As long as we're thanking each other, I think a large thank you to Mizmo for kind of being the driving force behind standards. I think it's important to note how impactful the standards are across the industry, not just in the way in which we talk together across industry, but also, at least in our instance at the U.S. Department of Veterans Affairs, how we're actually storing and governing our data internally. So we, in our modernization journey, have found a unique opportunity, a unique window to essentially redefine our data model in our modernization effort. You'll hear a little bit later from our executive director, John Bell. He'll talk a little bit about how we had 14 disparate data systems and storage vehicles and how complex that is. And so when you start unpacking that and trying to get better around how you manage that data internally, not just for the purposes of sharing it with lenders or servicers, appraisers, or in the secondary, but how we deal with that internally and how we deal with corporate VA and how we interface with DoD, so the standardization of our data internally. So thank you both for the external conversation, but also the internal conversation. That's great. It's been very meaningful for us.
Good.
That's great. So we've talked a lot about standardization, which is critical, and sort of consensus-driven approach. But Mike, are there ways where lenders are using technology, to differentiate themselves or compete versus sort of adopting, out-of-the-box standard approaches?
Yeah, it's interesting. The question about, when's the right time to invest in technology? How do you invest in technology? And we'll often get a group of industry CIOs together and just sort of talk about what are their priorities, what are their challenges, what are their hurdles. And it's been really interesting over the last decade, right? Coming out of the financial crisis, then you had Dodd-Frank, almost to a person in that conversation. It was all about, I got to invest in technology to be compliant, right? It was all about meeting the needs of the regulations. And that was a good part of the last decade, right? For better or worse, that certainly has added to the cost, but it was necessary. It's the cost of doing business. And then we got to sort of the late teens. You'll all remember the Super Bowl ad, right, where push button, get mortgage. There was this need that if you're going to have a customer, you've got to have a front end which is actually appealing, right? And you've got to meet a customer however they come in the door, whether it's through the phone, into your branch, on on the computer, however they're going to do it, right? And I think that became table stakes. If you don't have the ability to take an app, however your customer wants to do it, you're going to lose that customer, right? So again, that was a cost of doing business. It doesn't really benefit you in terms of productivity, other than the fact that you actually have a loan, right? But for years, I think the industry really was ignoring sort of most of the back office process, right? Because they had to focus on these other things. Now I think we're finally to the point, as we were coming to the pandemic, of, okay, we're going to tackle this challenge. So to your question, it then becomes, okay, am I going to do something back office, which is secret sauce, which is going to be entirely different from what all my competitors are doing? Probably not. And what I'm even hearing from some of the largest lenders in the industry is, maybe I made a bit of a mistake trying to keep all this in-house. Maybe I should partner with someone like Tim to do more of the back office stuff, right? Because I don't know that I have something that's so unique to my business process that I need to build it from scratch. And by the way, if I do, then every time one of these new regulations comes around, I'll probably get to rip it up and start over, right? So I think it's been this interesting conversation of, I think more and more using the MISMO standards, right? Using common processes, using sort of common backbones across the industry, because again, at the end of the day, it's executing on a business model that's going to be a differentiator as opposed to the tools you're using. I don't know, Tim, how are you thinking about it?
Almost the exact same way. So I want to say that with all humility. I mean, I think we're trying to break it down into three pieces, which is ultimately is an entity that helps lenders assemble a mortgage. I mean, that's manufacture a mortgage. We want to create an open network and open platform that allows lenders to basically use a tool that most efficiently helps them meet their prospective borrowers. Then, and this is what's key to us, is like once that information is coming in, how can that be assembled and analyzed and ensure compliance as that mortgage is being manufactured in a way that's rapid and efficient, such that you can get to the close quicker. And then, because once you're doing that and you're having greater certainty around close, you're able to interface with your customer with more direct feedback as to this works or here's what we need. You're able to manufacture or assemble that file quicker. And then ultimately that third step is once you have that file in digital form, once you have that mortgage in digital form, how can you get that ultimately registered and recorded efficiently, such that then down the road, and once that mortgage is ultimately being serviced by whoever it's serviced by, it can serve as a template for when that borrower is ready to explore their next opportunity in their housing finance journey, whether it's a refinancing, whether it's home equity loan if the time's appropriate, or ultimately, and most beneficially, when they retire the mortgage and want to get that lien released, and like having that be through a much more efficient and straight through process. And so that's what we're focused on, which is one, on that first step, making certain that we have an open dynamic network that allows people to use the tools that they want to use in order to source the information to populate that form, that file. Second, having that manufacturing process with us be as efficient as possible, with using the right set of tools to analyze the data that's coming in and compliance safeguards to make certain that it's ultimately going to be compliant for who's ultimately going to invest in it. And then third, have that file be as robust as possible to create a better consumer experience down the road.
Yeah. And Dave, I know we've talked a lot about interoperability and the importance of that, right? So
it
may be a common platform, but you want to plug in your specific widgets, right?
It is. I was about to mention that as you're going through is, that's, you hear that over and over and over again when you talk to people. It's like, I'm looking for interoperability. I want to be able to, pick, this solution here and that solution there, and know that they will talk to one another. Yeah. And it's open platforms, and it's been a huge shift where you go back, and I think you touched on you go back 20 years, and people had their closed ecosystems where it was their data. They only talk to themselves, and if it's an interface, it's some type of flat file interface that they're moving through. But as we move towards kind of the true innovation and being able to automate and being able to exchange data and everything, interoperability with standards is a must if you're going to be competitive.
That's the key.
Yeah.
Because you need that interoperability where people to choose their whatever tool they think is best to interface with their potential borrower on. and the more you can put standards around that, the better the outcome's going to be. Otherwise, you can end up having a loan file that looks like a 70s style Christmas tree with like all kinds of stuff all over.
That's quite an image.
But you know exactly what you guys know exactly what, those who've been around the mortgage market for a while know exactly what I'm talking about. Like having that flexibility to and I did grow up in the 70s. Yeah. But having that, having the capacity to take data where it's most efficient for the borrower, but trying to force that standards ultimately leads to a better digital file that is easier to refinance in the future or retire.
What also becomes internal to you as well, I know Colin touched on it just a bit ago, was having those same standards and pulling them into your internal architecture makes it very fluid as far as how you flow from, outside to inside type of thing.
Super belt and suspender stuff, and it's easy to geek out pretty quickly on it. But I did want to go back to Sam's original question of, is the time now? I think that's kind of the question that we're facing in the industry right now, and we have a great cross section here, so we talk to different folks. And there was the delineation, I think, earlier in the conversation about back office versus more front office origination. We've struggled with that, right? You're in a time of margin compression, lower volume. We're working through a banking issue right now that's been on the front news just about every day, and liquidity concerns. And then you walk into a lender shop or a servicer shop and say, hey, we should scale and do all these wonderful things. And, oh, by the way, wouldn't you like to invest a lot of money in doing this with us? And that's a really tough conversation to have. Yeah. But I think ultimately what we come back to, at least from the conversations that I'm in, in government, 2-year appropriation cycle, plan out 5. That's a tough thing to do in technology. Barbara Cooper-Jones will probably attest to that. But you walk into a lender shop and they're on the same cycles, right? They're thinking 12 months, a year out. They're planning their sprints, months, if not years in advance. So is the time now, or maybe it was the time yesterday? I'm not sure, but I don't think it's the sit around and wait. I think we really have to be all in on this because honestly, I think as a federal agency and administration department, we have to be thinking that far out to make our investments, and the way in which we interact with you and kind of standardizing that conversation, business to business, data to data, is a really tough thing to wait for the perfect moment in time. And I don't think that this industry can afford that right now. I think we really need to be forward thinking and making that investment into tomorrow.
Well, it's the line, the 2 best times to plant a tree, right? 30 years ago and today.
Yeah, exactly.
Today's the day.
Yeah.
Exactly.
Yeah. I know our members are looking for an immediate ROI, and it's just really tough to convince them to, that their investment is really for future thinking.
It is, but it's not 10 years away.
Right.
Right. We have wonderful things. The wonderful work that Mismo's done. We have great fintech partners like ICE and others, and I think it's important to kind of say, just in our journey, we, about a year and a half ago, we weren't doing anything in the XML space. We were collecting PDF files that our staff, in order to conduct oversight, were literally double keying into our systems in order to conduct oversight and for us to collect data. Now we have a 91% adoption rate on collection of UCD and ULAD information. That's a pretty quick swing for us.
That's huge.
Right? And so, and again, I'm not going to steal the thunder from my boss when he speaks later, but some of the things we're doing, in our API space is pretty remarkable, and I think provides that maybe not immediate, maybe not tomorrow, but next year kind of ROI, where a lot of the back office functions and back and forth a post-close or a QC person has to work through with VA is largely going to be streamlined. So it's pretty exciting.
Yeah, it's very exciting. I think we've all seen that sort of speed to market for those investments has really accelerated a lot, and that makes the value proposition a little more obvious. And obviously in a low origination, low volume environment, that relationship management, client retention matters a lot, and I think we're seeing a lot of exciting things from lenders who use the mortgage as a jumping off point for other relationships, right? And other sort of data collection that provides for other forms of credit provision. That's exciting, right? And we're going to see more of that. And I think this moment is really a time to think about the unique value add when you have to sort of fight for every borrower. So it's really critically important. I think you're right. It's either today or 30 years ago, but certainly today feels timely. So this wouldn't be a financial technology conference if we didn't talk about blockchain. So Dave, maybe talk a little bit about sort of how blockchain is being used now and sort of what you see sort of going forward.
That's a tough question. And I'll Barbara Cooper Jones. I mean, she did the nice dance on the blockchain, but I think that what you'll find and what I've found is that for many years now, there's been a lot of interest in blockchain as a technology, and I think there's been some proof of concepts here and there. But as far as finding a real adoptable space solution, whatever, for mortgage has been somewhat challenging for a lot of different reasons. Does that say that we're not going to get there at some point in time? I don't know. We have a community of practice within MISMO that has a group of experts that are looking at the various potential. Not only there's people. First thing is blockchain is not just one solution, right? So there's multiple different solutions within the blockchain space. But then the other piece is kind of where does it apply and how does it work, and are there things where it's going to kind of help from a data access or from a fungibility or from a security or you name it, and does that play off well enough against the speed necessary for processing? And so there's all types of things that start coming in. But I guess to answer your question, it's like there's a lot of activity, but I personally have not seen any wide-scale adoption of blockchain to solve any solution yet. So it's coming.
That feels fundamentally right to me. I think blockchain's a railroad. We have to figure out what you put on it and where you point it. And we're very much a part of that conversation, but it does feel like there needs to be more coalescing around sort of best use case.
Yeah.
And we should all need to do that and work together. So that's the one buzzword. The other one is AI, right? Mm-hmm. So we talked a little bit about that in the prior conversations. But Tim, can we talk a little bit about how AI is being used today, or how it might be used in the future in the sort of mortgage process?
Well, AI is such a loaded,
loaded in broad terms.
Loaded in broad terms. So I'll focus more on automation as opposed to artificial intelligence, because I think a lot of what we're trying to drive is better automation, which is comes down to a couple things. One, just populating the loan file. How do you do that in such a way so that you create an automated interface between the borrower and the borrower and the lender, and for that matter, whoever's ultimately going to insure the loan or potentially buy the loan, such that the loan file can be populated with the greatest amount of efficiency. And I think there's a whole slew of tools out there that can do that today. They just need to be implemented more readily by the industry as they become available. Secondly, there's the compliance process, the compliance check. Because ultimately, the vast majority of loans in the United States are going to be sold to somebody, or they're going to be insured and securitized. And I think that's where there's a huge opportunity for automation to come in collaboration between the private sector and the public sector, because I think the public sector, the agency, the GSEs, the agencies, the insuring entities, they know what they want to see, and like having those automation tools that can interface very efficiently as that file is being manufactured and then ultimately completed, to work with the lender to basically provide certainty on an automated fashion that compliance is done, unlocks just a tremendous amount of value. And then I'd say the third bucket in that regard is just the automation that can be brought to bear within the context of, how is the consumer then empowered to basically use that digitized loan file in the future. Once they know that they've completed a digitized loan file, they know they have this underlying, electronic document. How can they use that more efficiently when they want to go shop for a home equity loan, or when they want to go shop for cash out refi or refinancing, or when they want to release the lien? And I think automation can drive a lot of those things. How lenders use quote unquote AI within the context of they interface with their borrowers. That's ultimately going to be driven by lenders, and I'm not a subject matter expert on that. So
That's helpful. That's why I think from a borrower perspective, automation has been pretty key. I've watched Barbara and her team take a highly manual process that used to take 10 people in a matter of weeks, deliver something with bots that can be managed by one person. And again, for us, that's really, really critical, right? Because we are roughly 210 people strong, managing a 2.3 trillion book. And so every additional efficiency like that is material for us. So I don't know if there are other sort of automation or AI conversations to have. Colin?
Yeah, I think, AI is not ubiquitously understood or defined yet, right? It's important to realize that I think AI is a journey we're all still learning. It's all still very new, and particularly in an industry that has not historically been bleeding edge, it's a little nerve-wracking from a federal agency perspective or regulation perspective. And I think we've all seen the announcements the joint announcement last week by CFPB and FTC and DOJ and a few others. But I think Tim is right. We talk a lot about automation, getting automation good. And I think there's a lot of goodness in that in terms of a process, whether it be back office or front office. I think we're going to start seeing kind of a competitive advantage developed by some in the lending space around the use of AI for maybe lead generation, maybe initial interactions from a CX perspective. But I don't see AI being on the immediate horizon for actual decision making. Like hands off the wheel, we're going to get in this car and it's going to drive itself. I think we're on a journey. I think we're early yet, and I think that just in last week we were at a conference, the Loan Guarantee Conference, and I asked this very question to a lender and a fintech, and they were kind of the same mind, trying to figure out what this means. Big thinking, big idea, but not real galvanized, concrete ideas around what it's going to be, this year, next year.
But what amazes me in that space is how all of a sudden, the world believes that AI just, poof, it showed up.
It just happens.
It just happened. And it's like, it depends on, number one, what you put underneath that umbrella. And if you look at it, you can take it all the way back to late 80s, early 90s, where the first AI-type applications were rolling out. But secondly, and kind of, I think you were touching on it, it's like, I think the technology to fully automate all the way from, application through closing exists today. It's just, it's going to take having enough, having the critical mass of players being willing to accept what comes out of that technology before it can really be embraced and held. It's really, it's no different than, say an eNote, right? It's kind of like, how many years have we been looking at an electronic version of a document and, getting comfortable with it, that it's going to be, fungible, we can transfer it, we don't have, it's immutable, all of these things. And it's like, I think it's going to be the same thing with kind of the AI world too. So.
One of the areas that, at least I personally have been spending a lot of time thinking through is, is there automation that can actually help that first-time home buyer as they're going through that process, and what does it need to get a loan? Because which I think too often happens is somebody will come in, they'll be denied, and they stop.
Right.
Is there ways, one of the things we're thinking about, is there ways to automate the process of, at the current point in time, you need to do the following A, B, C things in order to get a loan as opposed to just a blanket denial. Because I think that type of automation and helping that lending officer, if there's a lending officer involved, or helping the online lending tool interface with the borrower in such a way that, using one of my favorite phrases, proactive and positive. Yep. When there isn't that initial approval, I think will be extremely valuable, particularly for a lot of those first-time home buyers. So it's automation in those areas that I think can drive a lot.
Maybe the step above too, where, before that, where it's more of a counseling and an education, and it's
and
getting them prepared.
Can I throw a couple more numbers in here just to ground us, right? Because 2003, if you looked at underwriter productivity, your typical underwriter was working 5 or 6 files a day, right? The number today is 1.5, right? Now, 2003 was probably too high, right? Because that was, I got a DU accept, I'm done. I'm not going to do anything more, right? That was not the right approach to underwriting a loan. Today, it's much more thorough, much more beneficial. But if we can get it from 1.5 to 2, right? And that's to your example of not rekeying in, a PDF document, like that's enormous. So I mean, AI, it's great. Like there may be some useful applications, but like we need to get from 1.5 to 2. We need to get a LO closing not 4 loans a month, maybe 5, right?
Yeah.
That would be enormous. And that cost data I was sharing, like, so I just think there are probably some lower hanging fruit that we can get first than go into an AI solution.
That's a great point. I think incremental change is still really critical and important, and sort of automation in support of human underwriting makes a lot of sense. The one thing I think that it gives you some comfort about the forthcoming debate on AI decisioning is I think policymakers are out front, thinking about the ethical use of AI, thinking about sort of what feeds an algorithmic process that can create results that are potentially inequitable. And at least we're aware of those issues now, so that when we have that debate and the technology is ready, we can really make sure that it is net positive for everyone, and not simply recreating pre-existing issues that we're all trying to fight together. That's a really important point. And I also think that we can keep walking before we run, and if we walk a little faster, we can all help a lot more people. And that's the important thing not to lose sight of.
And I think where you're headed was like, when training something like AI, training is just another word for what data do you expose it to?
Right.
Is it the right data? Is that data normalized? Is it accurate? Is there integrity behind it? Is there any unconscious bias in the person that created that data in the first place? Is there overt bias? And I think those are things that like real ethical dilemmas and questions that companies are going to have to face, regulators are going to have to face. It's really kind of an interesting time.
It's an interesting time, and there are sort of really large open questions around that sort of data access, data portability. How do we use consumer data to sort of help drive broader access to credit? So Mike, I don't know if you have a perspective on both what kinds of data we should be looking at as the next wave, because rental history is now becoming more mainstream, and then also sort of how do we think about protecting consumers as we help them use their own data more as part of this process?
Yeah, I thought Raymond's comments about getting access to the rental payment stream is critical. Particularly everything Tim, you really highlighted the need to get more first-time home buyers sort of in the queue, ready to go. Obviously, the announcement that FHFA made with respect to credit scores, that's an enormous task over the next couple of years, but that should enable some additional potential buyers to come in too. I do think we're at a bit of a crossroads here. It's interesting. This is both our speakers earlier made the comment that Europe's a bit ahead of us in some ways with respect to particularly data privacy. So the GDPR that was passed, California passed something similar. Sort of who owns a consumer's data, I think is a really important question. And I think it's going to potentially get a little crosswise with where we might want to go on the automation path, right? Because you want to make sure that things can go as quickly as possible, but you also want to make sure there are some stop signs along the way to make sure a consumer is fully consenting to how their data is being used. And I think we're making good progress there, but it's something to sort of keep in mind that may be more challenging rather than less going forward, depending on how the legal framework evolves.
Yeah, that's really thoughtful. I mean, we're always focused on velocity and access to credit and ease of consumer use, but at the same time, the decision to take a mortgage on is weighty, and you want to make sure that everyone is duly considering sort of what they're taking on and what they're sharing in order to get that access, and so that we have to be, as we get better at technology, we have to be thinking about making sure that something that's fast is also not, glib or too easy.
Right. And we do a tech profile survey each year. One of the things we're just tracking is sort of take up at the consumer level of some of the automated, VOD, VOA kind of things. And you just see some resistance there. Consumers not really wanting to sign into their financial accounts as part of their process, right? And that's going to be a challenge. But I think that's something that perhaps it's generational, perhaps it's just sort of comfort with technology, but it's going to be a bit of a hurdle going forward.
Well, not just resistance to logging in and doing the thing, right? But also, do they understand what they're providing? What access they're providing across perhaps a clearinghouse that, where a consumer can share their entire digital wallet with or in a future state, maybe multiple lenders at once. I mean, that's a kind of a scary prospect. And I think it's important that, that we really lean in and think about how to empower the consumer to control their own assets. Yeah. And their assets is their digital footprint, as it exists in the ether. I think that's going to be a really tough and interesting conversation.
That's right. And I think,
I was going to say, just as an LOS provider, I was going to jump in on the comment of using like rental data, which we're absolutely thrilled about the prospects of trying to support that effort, because we do think it's going to unlock a lot more creditworthy families to getting access to that first mortgage to buy that first home. But I also have like a real plea to the official sector that a well-structured, well-formed working group around how to do this is going to be critical, because I think about drawing 12 months of asset statements from somebody, highlighting have they paid their rent, have they been servicing their debts on time. That unlocks that ultimately will prove that you're creditworthy, regardless of what some numeric score that a scoring agency has produced. So because you can see it, but like now all of a sudden you have 12 months of deeply personal financial information. What do you want to do with that? Like, how long do you have to keep it? How should it be managed? How should it be stored? And that's why there really is a need for a true interagency process around that. To think about how that's done the right way with appropriate safe harbors for lenders, such that we can all make wise decisions around how we're managing that deeply personal financial information, while at the same point in time trying to unlock more credit.
great.
Yep.
I was just going to say, every time there's a data breach in the news, too, I feel like we're taking a step backwards, because then we lose consumer confidence in that space. And so we, really, how you frame it and how we control that data is just hugely important.
I think that's right. I mean, I think regulators have a unique responsibility in this space, an opportunity, right? Because if we can both help ensure compliance, but also make sure that consumers understand what their rights and responsibilities are, and the implications of what they're sharing, and that shared understanding can really drive some gains as well.
Alternative credit, I'd be remiss if I didn't kind of talk a little bit more about this. It's a really important, aspect of the industry for VA in particular, as we kind of help the industry to kind of help define the credit box of what the veteran demographic looks like. And I'm really excited about the options and potential behind alternative credit. I was put you on the spot, Dave, but any unique conversations in this space that you see from a standards perspective?
Not necessarily from standards perspective, but I mean, clearly there's a lot of exploration and activity underway about looking at what else can we add to the credit profile of a borrower to possibly qualify them for a mortgage. We're getting into a home. Do you know?
I mean, VA has certainly been a leader in looking at residual income forever, right? And I think the rest of the system is now coming around to the idea, well, you're onto something there, right? That and maybe that is the way to do a cash flow based underwriting. Particularly if you hear all the concerns in the news now about an over-reliance on something like DTI, where residual income is probably a better measure of ability to pay.
Yeah, but getting to the substantiating that residual income or what's left over after all the
there is work for Dave there.
There is work for Dave there, and it's important work because I think the way in which we verify those things feels very manual. The lenders are working hard to source the information, making sure that we have a good source of truth, and the more we can automate that process, bring standards into the fold, I think the faster this goes, and the more borrowers we can serve. Maybe widen that credit box to the maximum reasonable space possible.
I think some of the key things there, I mean, it's also kind of somewhat of a shift in how we think about data, because, if you go back kind of just a little bit, data was kind of put into these big repositories where it's gathered from all over the place, and then you got to it. Whereas I think that we're moving to a world, especially when you start, talking about privacy and consumers and things like that, of consumer permission data, so that you get it only when you need it, but it's there when you need it. Mm-hmm. I've had conversations over the past couple of years where I've had people say, we wouldn't even store any data if we knew that we could get it anytime we wanted it, right? So that way you wouldn't have the risk of the data breaches and stealing all the data from somebody because they don't have it. It's not there. I mean, you get it when you need it. So I think that's where you'll kind of continue to see see things change. And once again, it's how do you exchange that data, fast and when you need it.
Yeah, and you get going back to the personal financial information. This is where the official sector and the private sector lending can work together. Because think about cash flow lending. Ultimately, you're going to want to look at how that household is manage their cash flows and their obligations over a 6-month or a 12-month time horizon. Nobody's going to want to store 12 months of asset statements or bank statements or what have you over time, because that just makes there's too many bad actors that are going to have an interest in eventually trying to access that file. So is there something that the agencies, the GSEs can do in conjunction with the industry, to basically have a snapshot, to have that look, to basically green light the permission of insurance or the permission of a purchase without having 12 months of asset statements stored for 30 years, and putting the potential borrower at risk. Like these are the type of things where the private sector and the public sector, the lenders and the agencies need to really interface around if we're going to try to solve that. Because it's fine in a pilot form, but if you're going to try to scale it, the issues are going to become much more complex.
Oh, yeah.
It's super easy from like a metadata perspective, but when you talk to an auditor, on that loan that closed maybe 10 years ago, what happens, right? Show me the file. So there's a disconnect between this cyber kind of security mandate to have less data in-house, on-prem, in the cloud, wherever, versus what we need to kind of substantiate when we make decisions on a loan that was maybe originated in a cohort 10 years ago. So it's kind of like they're at crossroads, right?
There has to be some collaboration between the two, right? Because ultimately it doesn't make any sense to store somebody's...
Maybe like a trust me stamp. This was a good choice at the time.
I don't think that works either. But
certainly in the GSE world right now, a lot more repurchase demands than a few years ago. So I think what you're saying is very much front of mind, right? I need to be ready to defend that should it come to that. So.
Right.
Well, that's where the verifications ultimately have to come from the entity that's either insuring and or buying the loan on a much more real-time basis and have trust in that. If that's going to work, because otherwise it just won't be very practical to store a year's worth of bank statements for 30 years.
That's great. So Mike, are there any, among your membership, are there any sort of legal or regulatory issues that are coalescing that we should be aware of, that you're sort of focused on or concerned about or pushing for, that would sort of foster innovation or at least sort of take down barriers to mortgage innovation?
Well, I just mentioned the repurchase risk, right? I mean, that is always going to have lenders, tying their shoes twice, right? Making sure that everything is lined up. I think sort of a related point is, the GSEs are often the leaders, right? And are creating, call it a HOV lane for mortgage lending. But you don't know when you're first talking to that borrower that's going to wind up with Fannie or Freddie, right? And so I think it's an ongoing challenge of, I don't want to be locked into my secondary execution from the first time I talk to a borrower. I want to keep my options open as long as I can. And so then I think that gets to sort of Dave's world of then an industry-wide approach on as much as possible is the answer, so that you're not locking yourself in, right? And so I think that's sort of big picture. I think that beyond that, the CFPB obviously always very active and correctly very much focused on protecting consumers. But I think it leads to sort of a lot of, again, sort of additional caution, checking checkers along the way, which is adding to the cost issue I was talking about.
Speaking, Dave, of MISMO, sort of what is coming over the horizon? What are the standards you think we should be working on now for the innovations to come?
There's a couple of areas. I think probably the most innovative right now, or that we're moving forward on, and you touched on it, is around the entire electronic closing space, where looking at smart docs and multiple versions, both pre-close, post-close, is an area that, again, I think there's a lot of interest. I think that is, while we've only seen, I don't know, 5-7% adoption, something like that, that we'll see that accelerate. And I think a lot of that is because you are starting to see the kind of surrounding tools available that make that happen, such as like a remote online notary and some other things. Where it's like, why do you want to go somewhere to close if you can do it at your kitchen table or something like that? So that's clearly a big area. There are also there's a lot of interest in servicing right now, where we've got a work group that's looking at servicing transfers, and then we've got also the interest in kind of how do we continue down that path for servicing to kind of move towards a standardization of data for some of the significant transactions. But we've got a number of other work groups that are, I won't try to attest for what they're doing, but they are clearly, they're working on various spaces where they can, where we can look at innovation for those particular things. We've got, at any given time, we've got about 35 different groups looking at different aspects of standards around mortgage.
Great. A lot more work coming. That's
Yep.
great. So, Vaughn, I have one question for you. Forgive me, it's a little weedy, but after that we can take a couple audience questions if there are any. So, Vonda, what are your thoughts on the Article 12 controllable electronic records provision of the UCC that the Uniform Law Commission produced last year? And what are the implications for the housing finance industry?
Yeah, we're very interested in keeping our finger on the pulse of that, because our members have been asking us to take digital assets of other asset classes, not just the 1 to 4 first family mortgages. And we feel like Article 12 will open up that door. There's still, we've been consulting with one of the authors of the Article 12. So it was written with simplification in mind. And so there's still a lot of unknowns we're trying to figure out. How do we control that? Who is the keeper of the key? Mm-hmm. So, how they've explained it is whoever holds the key has the control. So is that going to be, from our perspective, is that a custodian? Is it an e-vault? Is it a registry? Is it a blockchain? Who controls that key? And that's really important for us to figure out. Our members, a lot of them are portfolio lenders, so this is foreign to them. They really want to take advantage of the digital innovation, and yet, they keep it in-house. They're not concerned of who will buy it in the future. We're concerned about that. So we have to take that one step further than whether our members think we should take that. But again, it comes down to the industry accepting that and doing it and all being on the same page. And I feel like we also need to, loan sale advisors need to be on board. I feel like sometimes there's educational opportunities in that area, because sometimes I've heard them say, well, we'll just add another discount for the unknown. Well, why is it unknown to them? Right. Let's educate that sector as well. But yeah, we're very interested in that space.
That's great. Obviously, we don't deal in HELOCs, but we're focused on supporting options for folks to tap.
Multifamily.
Yeah, multifamily is important, and then helping folks tap equity in their homes is an important tool, especially in volatile times. So it's critical work you're doing. That's really great. I don't know if we have...
And I'm going to just say that the commercial e-note working group is one of those 35-plus working groups in MISMO. So, if you're interested, join that group.
Yeah, absolutely.
So, Luke, I don't know if you're off somewhere, see if there are any questions from the web audience, but no? Yes? Yep. Go for it, Ashley.
Hi, so we have a question from the audience. As the panelists mentioned, e-notes offer the industry better access to data and better certainty around access to the collateral. What would it take, or when do you see this translating to investors offering better pricing for loans with e-notes?
That's a great question. It's a philosophical question. I don't know if anyone wants to jump in on that. Given we're still in a low utilization environment, right? But I think that's one of the things that we hope would happen, right? That as there's a ubiquitous access to e-mortgages and those efficiencies, coalesce, hopefully investors will see that as something advantageous for them as well. But I won't hazard a when. I don't know if anyone else wants to take a stab at that. But
I would just say what Elena said in her comments this morning, removing sort of each additional rock so the stream can get flowing, right? It's just, allow commingling within Ginnie Mae securities, I think will help. But I've also heard on the servicing side of, not every servicer is ready to take e-notes, right? And
That's
so
true.
The MSR value is going to be a challenge there. So the all-in execution is going to be impacted by that. So, but again, it's just sort of keep moving the rocks out of the stream.
Yeah.
We'll get going.
That's a great point, right? So we have, we've graduated, we're very proud of the work we've done. We've graduated our pilot into a program, and now our focus is integration and commingling because we want everyone to be agnostic on whether it's paper or e, and that's how you drive liquidity for the whole sector, but especially for what's currently a bit of a silo in our sort of e-collateral program. I don't know if we have time for sort of one or two more questions, actually, if there are any.
I don't see any right now, so if anything
Great.
comes up, I'll let you know, but it looks like that was our only question.
Great. All right. Is there anyone in the audience who has a question? Sounds like we covered everything. Great. All right. Well, thank you all for this great conversation.
Could I have
sure.
a brief commercial, please?
Go for it.
No, what I'd like to do is invite any of you that are not members of MISMO already to please join MISMO. And then the second thing is we will be having it's not quite spring anymore. The spring summit will be June 5th through 8th in Portland, Oregon. So I'd love to have you guys register and join us in Portland for a summit as well. And we've got several topics coming through where I know we're working with FHFA on their innovation sprints. Did I say that right? Yeah, thank you. We also have several sessions looking at the credit changes, which I think are kind of a hot topic, as well as a number of other topics. So love to see you guys in Portland.
Great. Thank you for that. And good to acknowledge our FHFA partners in the room as well. So thank you all for your time and your insights, and I welcome everyone to lunch.
I am not the afternoon speaker, but I did want to introduce him. So again, it was a great morning session. The first panel was fantastic, and I really enjoyed the conversation. And again, I hope this whole summit just reemphasizes the importance of the digital work that's going on all across government, and particularly here at Ginnie Mae and all the agencies that are trying to ramp up and get ready for what is the future. One of the things that I think about, especially this week, given that the pandemic, as we know it, is coming to an end, right? The end of the sort of federal declaration of emergency and the pandemic itself is subsiding, and and I know we're all grateful for that. Although it feels like the world has truly moved on at this point. It has been a significant and had a significant impact, I think, on the evolution of the digital world. During the pandemic, the need for the ability for people to be able to access mortgage and services and everything, and as we know, the pandemic years were very busy years for homeowners, refinancing and the like, and we heard a little bit about that on the panel. The ability to get things done virtually and digitally was crucial for what happened in the mortgage market during the last 3 years. And that is another reason why it's just so important to me. It's a lesson for all of us, is that we need to be ready. We need to be ready for whatever the next emergency is. Our business needs to go on. Our work must continue. We have to continue to serve people that are in need. And so, again, I wanted to just sort of bring it back to really the basics that's so important, that we have this virtual capability, digital capability, and this evolution and this journey is so important to us. It is particularly, I mentioned earlier that the VA, the Veterans Affairs Group, Housing Group, has been tremendous part of the growth we've seen in the digital collateral program here at Ginnie Mae. And 70% of all of our collateral there is our VA loans of some sort. And that's important. And it was really important during the pandemic. This was when we got the addition of loan modifications in the e-collateral space. That was crucial for service members working overseas who needed to do whatever kind of transactions, whether it was refinancing their mortgages, purchasing new homes, or loan modifications. And so I just want to thank the VA for really continuing to be really out front in terms of their work in making service members and the digital journey real for them and tangible and useful, because it really does matter. I want to introduce our afternoon speaker in that vein, and one of the reasons why he is our afternoon speaker is because of the great work that VA has been doing. So please, first want to say John is going to be joining us virtually because he is not feeling well today. And John, we're sorry to hear that. I hope you can hear me okay, and know that we are wishing you feeling better, but appreciate you still getting dressed up and coming to do this with us. John Bell is the Executive Director of the Loan Guarantee Service for the U.S. Department of Veterans Affairs. As Executive Director of the Loan Guarantee Service and a U.S. Navy veteran himself, John is responsible for delivering VA home loan benefits to his fellow veterans. Prior to his current role, he served as both Assistant and Deputy Director for the Loan Guarantee Service, leading the organization's COVID-19 response and overseeing transformation efforts. John has also had extensive mortgage industry experience, having served in leadership roles with nationwide lenders for over 20 years before he started his career with VA back in 2010. It is also Public Service Recognition Week, so I just want to say thank you, not only as a veteran, but as a public servant, to all of you in the room who are public servants. Thank you for your service, and I'm proud to work alongside you. And John, I'm going to turn it over to you, and we look forward to hearing your remarks. And again, thank you for you and Colin and the team being such great supporters and partners with us. Take it away.
Elena, thank you so much, and I will say right back to you, thank you for all that Ginnie Mae has done to progress our program, the partnership that we have. I certainly apologize I'm not there today. All of you that know me know that I wish that I was. I'm going to try to get through this, but I think coming off the hills of our LGY conference that we put on last week in Kansas City, I think I have come back with something. So it hit me last night, so I'm going to try to really get through this as well as I can. I'm not sure whether or not we'll have a chance to for you to ask questions, but if so, I certainly am here to do that as well. But again, it's so important as we look to modernization and the digital footprint, what Ginnie Mae has done first and foremost, and the work that they have on the digital securitization and the digital platform. As we mentioned, especially for VA, we have service members that are that are serving overseas, and if we can't provide a digital platform for them to be successful, then we're not doing everything that we can to provide this benefit. So I think the partnership. I applaud Ginnie Mae for the steps and efforts that it is taken in the modernization effort, and I really wanted to before I get into the modernization aspect of what we're trying to do, I wanted to first take just a little time to really explain this journey that VA has been on. So if you go back to 2010, when I joined, we really were kind of that safety net for veterans. We were that place where veterans could go when no one else would give them a chance. And while we still maintain that we want to be that that program, we also want this, and veterans deserve more from us, and making sure that this is the platform of choice for them, whether or not they want to go conventional or any other type of program, that they are suited and borrowers that could that could pick any program they want, but they pick VA because it saves them money. It provides them protections that the other programs don't, and they're able to utilize their benefit to its fullest form. So, in saying that, in that vein, we have been on this quest of how can we improve our program so that we are more competitive in the marketplace. Whether or not that's from a timeliness aspect, whether or not that's from the ability for us to offer quality, for us to offer more protections. We have seen a 650% increase since 2010. We have taken the appraisal time frame from 15 business days down to 7 business days. We think that we also have taken in that same time a 20 business day for eligibility, where a veteran would have to wait an average of 20 business days, down to where we are actually issuing over 80% of the time instantaneously that eligibility, and within 3 business days we're at 94%. And within 5 business days, we're basically 100% in providing that response. So we dedicate a lot of those time and resources in improvement of process, improvement of staff, and their knowledge of the business. But now we have to turn to what are the things that we can accomplish if we if we turn to modernization. What will modernization mean for us? One stat I love to say is that it took us 44 years to get to 18 million in the VA home loan program. Over the last 12 years, we've added another 10 million. So think about that growth in terms of as our path. We're going to see this month or in the next month, us get to 28 million loans for veterans since the inception of the program. But that fast growth means that we have to figure out a better way to offer the program and to monitor the program. Also, as you go to, if you look at the stats of market share, where, in 2010, we were less than 1%, and now we've grown, to greater. We're getting closer to 14. So that is a really healthy number, and as that number continues to increase, we want to make sure that we have the data capability to understand and to provide a more sustainable atmosphere moving forward. So what we did, first was kind of look internally and say, okay, where do we want our roadmap to take us? And how are we going to achieve that roadmap? Because what tends to happen in the government is we all come up with these great roadmaps of where we want to go, and then things come at us that we aren't well equipped to to serve, plus serving that roadmap. So if you look at a 5-year plan, and say within that 5-year plan, you have things like the PACT Act, you have the Mission Act, you have for us, PL 115-174, which was the seasoning rule. You have all these things that are coming at you from a legislative or bill point of view that you also have to accommodate your systems in which to answer. So we wanted to make a 5-year roadmap that could plan for those issues that occur, but also ensure that we are providing and staying on course. So at the end of that 5 years, we're seeing instant results. We're seeing those results that we wanted to see at the beginning of the planning stages. So what we came up with were our serve goals. So every day we are looking at how do we increase our ability to attract, develop, recognize, and retain a workforce that are equipped with the skills, knowledge, and resources to help us get the job done. So we focus attention on staff. Then we looked at, okay, we've got to focus on our ecosystem. How do we advance our technology? How do we become a more competitive and recognized product of choice for our veterans when they go to find a new home? And one of the things that we determine or look at on a daily basis is how are we competing from those veterans that are raising their hand, going for a bid, and are they able to compete? And what we're seeing right now is we're only about 14% off the purchase volume that we're seeing across the industry, which there are other programs out there that are anywhere between 30 and 40% decreases from last year. So in only being 14% down, we're still seeing very healthy increases in the VA home loan program. But how do you build that ecosystem in which to sustain that and grow? And then what regulatory reforms are we going to need in which to enforce or to train or to educate our stakeholders that are providing the benefit? And then what do our veterans need from a transparency standpoint? What do they turn to make decisions when it comes to the home loan benefit? And then last but certainly not least is how are we driving excellence across all those platforms? How do we deliver a high quality customer experience from that end user? So in all of our, so that's our serve goals. So our long range plan ties to each one of those goals. And that long range plan is then backed up with metrics called key results, so that every 6 months we're going back and saying, hey, are we meeting those key results in which to be successful? To give you an example of some of our key priorities right now, we have the pre-population of our loan review screens with data that we're deriving from the Uniform Loan Application Dataset, or ULAD. We're implementing a loan review API for lender testing. We're introducing a pre-close API for lenders to verify funding fees and learn policy violations. So basically, if you want to look at it, we want kind of a check-in standpoint of, okay, we have initiated the application's going to underwriting, is giving, this result from the AUS, we've ordered the appraisal. Now appraisal comes back. How are those things matching whether or not our guarantee or our eligibility are being met? Those are the checks and balances that we're trying to incorporate without having, without upsetting the timeliness that it's going to take to go from point A to closing. Then we've got our VASP program that will have some modernization components as well, but that is our servicing purchase program that we're building to basically take the place of our the old partial claim program. As we, as VA, saw that there are some definite issues from a partial claim standpoint, out and separate from the authority that we have, which we lost on 10/28 of 2022. There are definite problems with partial claims and a 25% guarantee. So we are going to propose a new program that we have the authority under our old refund authority called our servicing purchase program. Then we are working on 7735, which is the appraisal bill. We're working on assumptions, working on public law 117-328, which is a consolidated kind of appropriations act. It was the big omnibus bill. And then trying to increase culture and civility. We're working on a net promoter score for all this technology modernization we're about to get into, as well as our organizational restructure that we have been under for the last 2 to 3 years to ensure we made the right decisions in the right places, or do we need to continue to make some changes? So in getting into modernization, and what does modernization mean to VA now, is we have 13 different systems that we operate under. Those systems we're going to combine those and basically go down to one system. And that system needs to be able to be integrable across all of our platforms. And how are we going to do that is create ways by APIs, by AI, that we're receiving data and then communicating that data back to the industry, back to veterans, so that we can create a more secure environment. So the old days of our stakeholders coming inside the firewall, doing things, hand jamming information on a computer, are going to be over for VA hopefully within the next 5 years. If we meet our roadmap, then that will be the indicator that we have done what we needed to do to get those stakeholders having to come outside of their systems into our systems, and there'll be exchange of APIs back and forth, so that we can work together. We can get even more information. We can go from basically doing, right now we see anywhere between 1% to 3% of all closed loans. We'll be able to see 100% of all loans, whether or not closed or not, into our platform, so that we can share that information back to the industry, and we can create a more transparent environment, for those that are choosing VA, as their product of choice. So what does all that mean? And I'll walk through real quickly. So we have an eligibility API that will help external stakeholders to understand, or lenders to understand, how they evaluate veterans eligibility, whether or not veterans are funding fee exempt, whether or not there are any encumbered entitlement amounts. Those will all be automated, and to the point where we'll continue to automate, to where we're only looking at 5-10% of those. The rest of them will just be automated through the system. The appraisal API, that again is the sharing of information back and forth, and we'll be able to manage the appraisal process. So you'll be actually able to see what the progress of the appraisal is through these API events. Then our ROV process, our Tidewater process will all be incorporated in the sharing of that information so that we can have a more consolidated environment. Then you have pre-close API. Those are our APIs that I talked about earlier that will help us evaluate items before closing so that we can give that feedback so that as of day of close, lenders can then make decisions and sell loans instead of having to wait 30, 60 days beyond closing to fulfill that guarantee. And then the guarantee remittance API will be all about how do we interact and pay and have that guarantee exchange in a more automated and digital way. And then last but not least is our loan review API, which that again talks to really how do you put things into buckets, meaning you've got a lot of data coming in. That data is coming in, and how do you fulfill that data in the loan review screen so that we can understand are the mistakes that are occurring, do they need to go into a training bucket? Do we need to focus more on an education and certification bucket, or do we need to go the enforcement side of the house? And this information will help us look at more information so that we can share that information back in our lender scorecards, our servicer scorecards, our appraisal scorecards, so it'll make a healthier environment and a healthier program for everyone involved. So what will LGY APIs do for the industry? One, it will improve veteran outcomes and experiences. It will help lenders. It will allow you to stay in your LOS, give you the opportunity to automate all of the VA processes by saving process time. It will eliminate manual data entry, but it will also give you some early detection of issues that are arising that you can take care of before closing and not have to worry whether or not your guarantee is going to stand. Then from a technology standpoint, it will give existing VA home lenders the incentive to remain with their current providers. But it will also allow us to switch and be more collaborative in all of the providers that are providing, fintech to the industry as it is now. So we see this as a more interoperability play where information can exchange and flow in two different ways, but it's not tied to just a platform to do work. It's actually, you're able to use data and exchange that data to understand from an analytical standpoint, where you are in the environment. And then for LGY, to improve our turnaround times, eliminate data entry, which will result in higher quality data, and then again, earlier detection of issues concerning the guarantee. So this will allow us to integrate again on a single software platform. It will enable us to decommission legacy systems. We will be able to publish our library of available APIs from a business-to-business data exchange. It will limit external user interfaces, and which require costly manual data entry, human error, and delays in reporting. It will provide a robust data and analytical capability, automated oversight, and we will have a fully adopted industry data standard with MISMO that will simplify and expedite data exchange across the entire mortgage landscape. So with that, I think I'm ready to take some questions.
Thank you, John, for giving us the history and where we are today and the future of the VA Loan Guarantee Program. We hope you are feeling better just from getting to talk about all the positive stuff that's happening. And now we are going to ask for questions from the audience.
Thank you, Felicia. Good to see you.
Good to see you too.
It was great to see you last week. Thank you so much for your attendance at our conference last week, by the way.
We were very proud to be there, and with all colleagues from the VA, we are so grateful for everything that you are doing in your programs and the amazing volume that we see every month coming through. It's a testament to everything you're talking about today and what is going to happen in the future. And the partnership is strong, and I am very grateful for that. All right, I've got a microphone, and I'm looking for somebody with a question about the VA program. Yay, Angel. Please introduce yourself before you and speak into the mic when you ask your question.
Thank you, Felicia. John, good afternoon. Thank you for joining us. This is Angel Hernandez with Stavi. So just a quick question. As we consider sort of the full suite of APIs that you guys are rolling through, internally, what impact do you predict this will have in the allocation of, again, how many tasks have to be outsourced today for contractors and the relative performance of any task that's outsourced today? You think, again, generally, is that going to give you flexibility, lessen your dependency, speed of processing times? What can we expect on the other side?
Yeah, no, thank you, dear friend. Good to see you. And again, thank you for attending last week as well. Look, the whole reason why we wanted to go in the route that we're taking was we wanted to get off of this whole environment of being dependent upon workflow, dependent upon one certain fintech. We wanted to make sure that when we create this ability to exchange data, that we wanted that exchange to be as easy as possible. And our hope is by doing that, it allows even more and greater ability for us to think outside the box and to create even a better way to look at data and to look at analytics and how we're using that model. So let me give you an example of kind of how we got here, and that was that it always frustrated me in making policy decisions and not having the performance data, to close that loop. So what policy decisions can I make? And if I make those policy decisions, what does it mean to our veterans downstream in 6 months, in a year, in a year and a half? What does that outlook look like? So by allowing for more data to come into the space, by using those analytical models to understand. Are we okay? I was going to say, can you hear me? But by using that information, I'm able to now make those decisions and understand the consequences by making those decisions downstream. So my hope is that it's going to create even better, a more integrable environment, so that we can get more fintech into the industry, at least to help VA. That's all I can speak to. But
thank you, John. Anyone else? Yes, Lynn, we are going to ask you to come up here to ask the question so you can be on camera. Full disclosure, after we get someone to do the questioning.
Okay. Hi, John. Nice to see you. Lynn
Hey,
Chandler. You at the VA, of course, are in the same boat that we are, which is we really want to advance adoption, but we cannot, the U.S. government can't appear to endorse particular vendors or otherwise, guide people to resources that might be really helpful to them. What would you recommend for people that are analyzing how to adopt a provider or what they should look for in a provider for e-close or e-technology?
Oh, that's a great question. I actually love this question because I get it. The frustrating part for the agencies, right, is that you buy a certain fintech, and then at the end of that time frame, what do you do with the data? Like, it's your data, but if you're going to switch the platform to another platform, can you even use that data inside that platform? And so it has been something we've been plagued with for quite a while. My hope by building it like this and building a model that is centralized to data and making data really the keynote speaker of the modernization play, it's that data can be used because it is inside your your data space, your data environment. It can be used no matter what program that you plug or play it into. So interoperability was like the keynote thing we were looking for VA, where we wouldn't have to address, whether or not we used a certain platform for the work that our staff was going to have to do. It was that we would have that freedom to use different types of fintech, because our data would go to one place. We would be able to use that data. It would be defined by the industry, and that definition would come from ISMO, and we would be able, because we had that governance over the data, we felt very comfortable in moving into that environment. Did that answer your question?
Yeah, I think so. Thank you.
It is certainly a partnership that we value and continue to value. So thank you so much.
Thank you for coming to our second panel in our Digital Innovation Summit. I'm Lynn Chandler, the director of Ginnie Mae's Digital Collateral Program, and we have some great guests today. We have Emily Overton and Natasha Rader from Veterans United, one of our star e-issuers that was part of our pilot program and is continuing to do great business with Ginnie Mae. And then we have Anna Moravins, who's from US Bank, also an excellent partner for us at eCustodian. And then Simon Moyer from eOriginal, and who is our eVault provider. And then online, virtually participating today, we have Eva Torres and Selma Omerich of TIAA Bank, a warehouse lender that partners with one of our e-issuers. So we like to think we're taking you through the ecosystem of the eNote. We start with the technology provider, with the vendor, and then we move through to the actual securitization, and then we retain the documents and we review for validity with our custodian. So we really have all the perspectives here today, and we hope there's something for everyone. We know that there are people in the audience who are sort of at the 101 level, learning about eNotes for the first time, and then we also have really experienced providers, who we hope will be able to get some nuggets of wisdom as well out of today's panel. We're going to start with Simon, who can introduce himself more thoroughly than I did, and is going to take us through, what is an eNote? What sort of is the foundation of that technology?
Yeah, hi everyone. I'm Simon Moyer. I lead the banking compliance group at Wolters Kluwer. But I came to Wolters Kluwer through an acquisition of the original that has been doing digital lending, digital asset management for over 20 years. And I think back to my first experiences with Ginnie Mae. I remember sitting in the boardroom, and we really did have representatives from the whole ecosystem really very interested in what could we do, right? How could we, in essence, serve the folks who serve, and also serve the folks that might be underserved as well in the Ginnie network. So when we think about the Collateral program, it really starts with a digital closing, right? And electronic closing is what's known in the industry. And an electronic closing can be in many different forms, right? The real definition is at least one document in the closing package is executed, digitally or electronically. But I think what's really important is really focusing on what's truly important in that package, right? There's 3 types of documents, really. The first one is the promissory note, right? Which can be electronic or it could be paper. The next one is the security instrument or anything else that needs to be notarized, right? That is also another set of very important documents. And then the last ones are just documents that just need to be electronically signed, but may not need to be done in a very particular way or stored in a way after it's done. And so with that, you have all of these different forms of e-closing, right? You have hybrid, you have full, you have RON, you have IPIN, you have all of these different types of forms of it. But the big thing here is that it's being done electronically in some way. And I think for the most of the topic today, we're going to be talking about e-notes, right? So that's the most important one. It's the promise to pay, and it's the one that requires following the law to make sure that it's legal and enforceable.
Yeah, that's a good point. We do like to educate that the e-note, because it's a negotiable instrument, has additional protections around it. So, I often get questions about, well, if I just scan it in, is that an e-note? No, it's not, right? There are a lot of legal complications surrounding the note in particular. And so for us at Ginnie Mae, an e-mortgage is defined as a document where at least the note is electronic, and it's both, it's closed, executed, stored, transmitted, all electronically in an appropriate manner to be e-sign compliant. But now that we know a little bit about e-notes, we want to ask about all of your e-note journeys, because that's really helpful for people who are thinking about getting into the game. They need to have the right investment at their company. They need to have the right enthusiasm. Fortunately, we see a lot of that. But how did you get started? What was the beginning of your journey, Emily? Or Natasha?
Natasha's going to lead this one.
Yeah. So I'm Natasha Rader. I work at Veterans United Home Loans as the VP of Product Strategy. And we have Emily Overton here too. So I really focus on the customer experience side and the technology that we use to leverage the e-mortgage experience, and then partnered a ton with Emily, who really focuses on the capital markets back-end process. So that's why we've got both of us here to provide the full picture. But our journey was really simple. It was really easy for us to step in. Our mission as a company is to enhance the lives of our veterans that we serve. So this just fell right into that. We want to make it easy for our veterans to earn their hard-earned benefit, and we don't want them to have to work hard to go through that process. So when we hear things like the RON POA, it was an easy one for us. We've got our veterans overseas. We want them to be at the closing table. We want them to be part of that experience. Or even like National Guard members who are called upon for state emergencies on last minute. Like, that's very important for us, and we run into that quite a bit. So it's a really easy answer for us to get started in that. We knew we got started around 2018 is like when we really started to explore in this space. We quickly learned that we wanted to start with the hybrid, get our upfront processes figured out, trained our loan officer teams, our title company partners, our real estate partners comfortable with the process up front, and then quickly ramped up with the eNote space and really scaled a lot in this past year. So.
Anna from the custodian perspective.
Yep. I'm Anna Moravins. I'm from U.S. Bank. I've been with U.S. Bank's stock custodian group for about 18 years now, and I've been doing really the same thing for the whole time with the paper processes. So my familiarity with our paper certifications for Ginnie Mae naturally helped me move into helping determine what the eNote processes would be once you guys decided to roll that program out. So my job is really to help make sure that we're meeting all of our obligations and requirements for a custodian.
If I could just comment on that, right? You mentioned you've been doing this with paper for so long, right? And you know, an eNote, although it is electronic and digital, it needs to go through the same, you know, processes, right? It needs to be, an unsigned note has to be created right in the right way. It needs to be executed in the right way. It needs to be managed in the right way. It just happens that you're now doing it in a digital format. As you said, there's a negotiable instrument, right? When it's electronic, it's considered a transferable record. And there's regulations that guide that, right? Safe harbor, 6 safe harbor items that must be met when handling that eNote, right? Because again, got to come down to it, is it legal and is it enforceable? The most important things to it.
Technology becomes relevant to an organization that's decided to implement e-closings. And of course, we do have people who want to start small. They want to start with a hybrid. They don't want to go full e-close at first, but where should people get started with technology?
Yeah, so I think obviously the first thing is signature, right? There has to be some way to put that electronic signature on the document. So there are different providers out there that offer that capability, and that really supports that hybrid model. Often what occurs in that model is the borrower gets documents in advance of the closing, right? Maybe a few days in advance, depending on the documents, might be the day of the actual close as well. But they can be executed independently of anywhere else, depending on, of course, the state and the guidance for that. But they could also occur at the table, right? It could still be a hybrid that occurs at the table. The next thing is you can look at is in what format are you going to actually do the closing, right? And that often is the question about remote online notary, right? If you're going to be, truly digital and do it from anywhere, then remote online notary is really required. What is important to note is, although that's very important technology, a hybrid or an eNote doesn't require that e-notary to occur, right? So even though you have eNote and e-notary, they're very different things, right? So you can do it across all different states. And then the last thing, especially when we're starting to talk about notes and electronic notes, is really a vault, right? So different technology providers are out there delivering that technology to the market. It follows a standard, right? There's a MISMO standard. It integrates into the MERS system to ensure that you have the registry along with the actual holding of the asset inside of a vault. And so that's sort of the final set of technology that needs to occur.
And we can ask Emily and Natasha about when you were implementing all of these technologies that Simon talks about, what were your greatest challenges? What obstacles did you have to overcome?
Yeah, that's a good question. I think since we got in the landscape pretty early for our industry and for our market specifically, Simon kind of hit on a couple of them. It's like build up your dictionary. Everybody has different terms. Everybody's definition of a hybrid is different ever so slightly. Don't just assume by saying hybrid in the market that you're all talking about the same thing. So ask questions, build up that dictionary that you want to use internal and be clear with that externally. I would recommend staying customer focused and customer centric. You don't want the closing experience to feel choppy with everything else that you've digitized up front. You want it to be seamless. You don't want your customers to have to necessarily learn a new process just for the closing table. And then I would also say when adopting, one thing that we learned is there's just a lot of overlays with different state regulations following Ginnie's Collateral program. So we really recommend going state by state just so that you can understand what overlays that you need to put in place to adhere to state laws or local laws or even preferences from title partners. So yeah, I think those would be our big ones. And also testing. Don't skimp on the testing is important. Yeah.
Yes, and I think in previous conversations with Eva, who's joining us online, she says that from the warehouse perspective, they emphasize the testing too. You'll hear it from your custodian, you'll hear it from your your warehouse lender, you'll hear it from us. If it gets to us and you haven't gone through the testing, we will notice and we'll have to unwind more than you want to unwind. So there really are no shortcuts. Do that testing. Anna, what, from a custodial perspective, what were your obstacles that you faced in the journey to E?
Yeah, honestly, the biggest one is very similar, which was terminology, making sure that everybody's talking about the same thing. A lot of times we find that they're not. We'll have issuers call us and say, hey, do you guys handle e-notes? I sent you a PDF. And we might have to let them know what an e-note is or who they need to work with to get established before they can work with us to start delivering their e-notes. So the terminology, getting on the same page with who you're working with, knowing who the partners are in the whole transaction. Sometimes it's not just a custodian and an issuer. There's a warehouse who might be delivering for them, and that requires a connection between the e-vaults. So those are challenges. They continue to be challenges, but it just comes down to communication. Really is just making sure you're having that first conversation with all the parties involved and determining what are the needs, what are the expectations, and who does what. And like they said, testing is key. That will expose all the issues.
Yeah, that's great advice. We also spend a lot of time in education. That I recently had some calls from people that are very excited to be in our program, and they sent me an e-custodian application when in fact they were a warehouse lender and they just didn't know where they fit in the Ginnie Mae universe. And we don't have direct contracts with warehouse lenders, but we recognize their important role in the system. And so, we're happy to have those conversations with anyone that would like to hear more about our program. Simon, would you say these approaches and challenges are consistent with what you're seeing on your end as a technology provider?
Yes. But just to expand on it a little more, I was going to ask a question of you, Natasha, before of where did the initiative grow from, right? Like what group actually sort of created the idea and then truly sponsored the idea? Because when you look at a process like this, it really has multiple types of benefits, right? There's certainly the customer experience, the borrower experience, right? It can be incredibly seamless, right? And not only during the process, but after as well, right? They can receive electronic copies of those documents. They don't have to wait for half an hour in the settlement agent's, office waiting for a copy to be, created of the signed documents. It can also be operationally, right? So what are you trying to do in your post-closing operation in regards to, quality and making sure you're perfecting the file before you send it on to the investor or to the capital markets. And then another area that we sort of see the sponsorship coming from is the capital markets group itself, right? And so, I guess after that long intro, Natasha, where did it happen for you? Who was the sponsor?
Yeah, for us, it was customer centric and veteran focused, and the customer experience around that. That's really where we jumped in and why we saw the value there. Understanding the why, if you, as a company, whoever you are as a partner, really understanding the why and being empathetic towards other partners in the space. It's going to take all of us together to deliver this experience. So for us as a lender, it is customer focused. That's who we're dealing with day in, day out, right? Yeah, there's operational gains and wins, but that comes after the customer experience. And especially in a time right now where margins are compressed, people are kind of maybe not focusing towards efficiency side and maybe focusing more on the conversion side right now to help with margins with the industry the way it is right now. But I would say that look at it from the customer experience. Like, what are you wanting to serve for your veterans or for your customers? And that in itself will help the margin side downstream, like stay customer focused. And just, yeah, that was our why around it.
Yeah, I think that is important, right? To stay true to what the initial reason was, right? Like you can get too sort of spread out, right? If you try to achieve too much too quickly, whereas if you can point back to that, the borrower customer experience and see how that's truly changing the game, then you can then, as you said, add on.
Speaking of that, Natasha, where have eNotes enabled your organizations to add efficiencies like automation into the process?
Yeah, we've noticed quite a bit of efficiencies in automation. Our partners have done a great job helping us with automation, building automation around the MERS, e-registry, automation around control and location. eOriginal has been great in all of that for us and keeps innovating with us to find those automation and efficiencies for the capital markets teams, but we see efficiencies even more upstream. We've built technology around how to handle with title companies. We're purchase focused, so we work with hundreds of title companies. So this really forced us to really start to think through, like, what does that communication process look like? So the title companies who are dealing with the full wet package and title companies who are working with the hybrid or an eNote or a full RON, like they really know like what they need to execute at that closing table. And so that's helped a ton of efficiencies for our loan teams, transparency on communication on where things are. We've seen a lot of efficiencies for our funding teams, being able to turn funding times faster. That allows them to work more files, but it also allows our veterans to be at the table for a shorter amount of time so they get their keys in hand faster. Yeah, and then there's a bunch of capital market wins downstream, but those it's interesting because you start with a why and then it starts to spread as you start to build on top of it. After you take the baby steps to get to your why, it grows and you start to see the efficiencies throughout your company. So
yeah, and that reminds me of a conversation we were having with Eva from our warehouse bank too, is how are you drawn into this process? Is an eNote really better for a borrower? Is it better for the lender? Are you doing this just as a function of customer service, or does everyone in this system? We have data to support that the lender is definitely winning in terms of cost reduction, error reduction, time to close. But what about the warehouse lender, Eva? Is this a win for you as well, or just a customer service?
Yes, no, it's actually a win. I would have to agree with Natasha as far as the processing of moving loans through quicker. We only see the eNote. We don't get a whole e-closing package, but it enables us to move that through quicker, being the middle person in the process from the mortgage company to the end investor. So like I said, I'm in agreement as far as the efficiency of it. We don't have to worry about items being lost, notes being delayed, things like that through mail process, FedEx, whomever a customer may be using. So it does create a lot of efficiencies for us on our side.
Great. Anna, would you say that's the case for custodians as well?
Yeah, absolutely. Any electronic documents provide a lot of opportunity for efficiencies, especially automation. And quite honestly, the eNotes specifically, they result in reducing risk. If the more human process you eliminate, the more risk you reduce. Just where the eNotes are. A custodian's job is to store the eNote, and when it's a paper eNote, yes, it's received. We're verifying it's received, but when it's passing through humans' hands, it can get lost. Not that we ever do that, but
right. No.
But naturally, an eNote is a difficult thing to to lose, obviously. So you reduce that risk, and then the automation or that you can put into place to even just perform the review eliminates errors in reviews done incorrectly by a human's eyes.
And I mean, you know, the e-note was promised to do all these things. It was promised to reduce errors, to cut costs, to cut time. Is that something you see? Do you have the data to support that at Veterans?
Yeah, we do. I can let you expand on it if you have more details, but we see that it does. We can securitize loans quicker, 1 to 3 days quicker than what we do with paper notes. We see a huge benefit in costs in mailing supplies and cost alone. But going back, back to the win for the veteran, we do send out, customer satisfaction ratings for them to rate, and we rate all of our closing experience, and the more experience rates much higher. The veterans like it; they want it that more than the traditional experience. And the things that they really love about it is that they can get to the documents before they get to the closing table, so they're more educated when they come. They're not feeling rushed. They understand what they're signing. They can ask details and questions of the loan teammates or a title company prior. They like that they're at the closing table for a less amount of time. Everybody's busy. Everybody wants more time back in their day. So that really helps. And they're busy doing all of the activities that they need to do. And then we're also seeing that the QC process is a lot better. We can, place where you need to sign, where it needs to be dated by what party, and we can put all of that up front, which also helps our veterans not have to come back to the closing table to fix something that maybe we didn't execute appropriately with the title company as well. So there's that, but I don't know if you have more details other than that on your side.
I did. We were going to talk about it later too, probably, but we've definitely seen efficiencies when we're creating our pools. If you have a pool of e-notes, it's going to certify next day at the latest, most likely. The note is there instantaneously. And then, that can drastically change your pooling to settlement times. If you as a company are looking to save costs and get your pools settled faster and get those securities and the funds sent, this is absolutely the process that you want to dive into. It's been extremely efficient for us.
I was going to say, I think that's interesting about if you want to go faster. It allows you to do the transaction in the time that you want to do it. You're not being controlled now by some physical item. Right. So, we talk to, different lenders, right? Certainly when they're pooling, they might choose to keep it a little longer, but when they do want to execute, they can do it instantaneously in essence, right? I think one other comment I wanted to take from you, Natasha, was just around the excitement that we see on the lender side of the transaction. I think they do see that, borrower experience, customer experience type of perspective. We've seen it on the investor side, right? And with Ginnie and Fannie and Freddie supporting it. It is interesting, right? In the middle, right, with the warehouse and custodians. And I think a lot of people were concerned that maybe there wasn't the advantage for them, right? That the warehouse lender was going to lose dwell time and lose interest, right? But you can hear from Eva, right? There's risk, right? If you've got money out that you've funded and you're waiting for a note to come, with an e-note, it's immediately there, right? You feel comfortable. Likewise with the custodian, right? They, people were like, are they on board? And I think we're seeing more and more. US Bank has been doing custodial services for across multiple asset classes for many years, right? And so I think it was a natural sort of evolution for you guys to get into mortgage as well.
Yeah, that's great. Well, we're so glad to have all of your perspectives, and of course that we've done other conversations as well with other lenders who back up exactly what you're saying here. On our website, you can see our podcasts and our webinars that we've done. But a perspective we haven't heard that much from before that I get a lot of questions about is the warehouse lender, Eva. People are always, you've been doing Ginnie Mae securitization with us for e-notes since we launched our pilot. And so that, to answer that question, there are warehouse lenders in this game who are very comfortable in this game. But But tell us a little more about it. Tell us, what is the role of the warehouse lender in the eNote securitization?
Well, it really changes just slightly from a paper note to switching over to an eNote. So it's actually a smooth transition to move over into the eNote world. With warehouse lending, what we're doing is we're extending lines of credit to mortgage companies. So, once we sign a contract with them, then those things will come into play. However, what we're doing is, what we see is when our customers are coming to us and saying, we want to be in the eNote world, the customer also obviously has a couple of steps to do within that. But what we're doing is, we do have several customers that are moving eNotes through. Like you said, Lynn, we've been doing Ginnie Mae eNotes for a couple of years now. So we're in the trenches at the beginning. One of the things I know that's being repeated here, training, testing, things like that. It's so imperative to do all of that in order to get this where we are at now, which is a smooth transition with eNote through the Ginnie Mae platform also, So, Selma, who has joined us also, she actually moves those notes through on a daily basis. So she gets to handle some of those, customers unfortunately come to us and say, okay, we're ready to send a Ginnie Mae, and we get to, either Selma or myself, more Selma gets to explain to them that these notes can't be moved because we haven't done testing with Ginnie Mae. But we have gained so much. We have gained so much as far as dwell times, security within, just like you said, when a warehouse lender is sending out funds, we have to have a note. The quickest way for us to get that note is to have an eNote instead of waiting on the mail. If we don't receive that note, then we have money out without anything in hand. So eNotes has become very fluid for us to do this and be more secure in our position with our lender, as well as getting items, notes to an investor, an investor. So it's worked out really well for us. Some of our customers, I apologize, sorry. Some of our customers, they are just starting to go down that Ginnie Mae eNote path. And we're running into a few bumps, but we're trying to get them to understand the importance of different items that are required, not only from the Ginnie Mae side, but also from our side as a warehouse lender, in order to make sure all of us are secure with what we are doing. Sending out money, moving notes. I've been in this business for a long time, and we've seen what happens when notes are not moved properly or they never show up, things like that, with regards to extending lines of credit. With this, it tends to give us a little bit more security. Now, what our customers have to do with us, of course, is when we're executing an agreement with them, most of the time, it's a rather smooth transition. It's part of the original agreement. Every once in a while, we'll have a customer who did not bring up eNotes within their first agreement with us. So what we'll do is we will do an addendum to an agreement. Selma or myself will reach out to legal counsel, and we will let them know that one of our customers is actually interested in eNotes, Ginnie Mae, using Ginnie Mae as an end investor, things like that. So every once in a while, we do have to have new contracts drawn up. It doesn't impede our process as far as moving forward, though. The customer will then, of course, initiate the process with Ginnie Mae to get approved to use Ginnie Mae as their, end investor, and to be able to pool, to securitize these loans. And then we just kind of sit back until they're approved through the Ginnie Mae process. It's going to be cyclical in nature. There are customers that are just not quite comfortable right now to use an eNote, but I think as we move forward, the confidence will be built. And I'm not just saying we, TIAA, I'm saying we as an industry, as far as all encompassing. As we, eNotes were rarely used a couple of years ago, and now it's in the forefront with regards, to it's quicker, it's safer, And, the end result is the customer gets their keys in their hand sooner instead of waiting. So been a very great experience to move into eNotes. At first, we also had our trepidations and had to move through some problems of our own. But that's just more of testing for us. So we've enjoyed it. It's an easy process once we get our customers moving on it.
That's a great point. Emily and I were having that discussion earlier as well, which is we all run into customers that just aren't there yet, and I think not that I'm here to say I've solved the problem of eNote adoption. I'm here to finally answer the question how we can move it forward. But I do think that that's a lot of where we are now. Is there's not one block of people that are uniformly not on board. We've got the warehouse lenders on board. We've got the custodians. We've got the e-issuers. But our normal business partners are not all on board. They all haven't reached that same level of comfort. And so what we can do is just, as you said, continue to educate and continue to increase that comfort for people. Are there any trends you're seeing with the number of loans being funded consisting of an eNote, or with the number of your customers who are adopting eNote? Where does it stand as a percentage of the whole for you?
I think as far as on the whole, out of our customer base, probably about 30% of our customers are using eNotes at this time. Some of them actually are still a little, intimidated by it. So they do have an eNote platform, but they're still sending us paper notes also. So it's just a comfort level, getting any customer comfortable with the eNote process. Whatever vault they're going to use, we are working with the different vaults involved, the e-vaults. A customer, we do not send them to any particular vault. This is a customer choice. It's not our choice. We let them choose theirs, and then working with that e-vault that they choose to then work with our e-vault, and of course getting the customer to start using that. Like it's more of just easing our customers in. The ones that are full in, it took a little while, but now they're fully in, and keeps Selma and her group very busy, with just processing eNotes throughout the day. So, but it is a slow process at first, and as to be expected, we hope that it continues the way it's moving, where it's that 30% is moving to 50% of our customer base, and then of course eventually we'd love to get to 100%. So it's just cautiously optimistic, helping our customers.
Simon?
Yeah, I was just thinking about the mindset that you have to have when you take on this, right? You don't want to manage the eNote as the exception, right? You want to manage the paper as the exception. And so what we see with folks who have that mindset, that is where they get the growth, right? Now, legally, you can't force someone to sign electronically, right? So just want to make sure that everyone understands that, right? That you can offer the ability to sign electronically, but someone can deny it, right? And they can just choose to do wet sign. But that's the sort of that mindset, right? The likelihood that they're going to sign electronically is very high if you offer it to them, right? Because they're used to now in today's society.
Yeah, the borrowers are there.
Of electronically signing something. One other comment that I made me think a little bit is around we've got to educate, we've got to train and everything like that, and maybe get some feedback from the audience here. This is not actually hard. Right. It's if you set your mind to doing it. Right. And again, that's sort of what we've seen. The lenders who have said, hey, we're all in, very quickly do people understand the terminology, the process, etc. And what we've even seen is competitors out there, lenders or warehouse lenders actually educating each other as well. Right. Because there is a real benefit to bringing the ecosystem along on the ride. Right. So if it's not just a friendly competitor, Ginnie has, documentation, Fannie has, MERS has, etc. Everyone is there to help folks.
I think you're absolutely right. Every person on this couch certainly has educated, is willing to educate. I take hundreds of phone calls for people who just want to learn more. And that's what I've always loved about this space, actually, is that people who are in it are passionate about e-notes. And I hear over and over again, even though it's my business as a lender, I just want to foster adoption. I'm not in it to be competitive. We just want to move the ball forward. So I'm excited about that. Eva, before we kind of get too far off the warehouse topic, I did want to ask you in terms of Ginnie Mae versus Fannie Mae, or Freddie Mac for that matter. Again, not being competitive, but just want people to understand our process is a little bit different. We'll get into some of those differences or the unique elements for the Ginnie Mae process. Is that something that you've noticed? Has that been a challenge for your customers?
I think the challenge comes with, the testing with Ginnie Mae. And of course, I'm all for testing. Always want more testing. I want a customer to feel comfortable with what they are doing. So the trend, the transition for our customers can be a little bit more difficult instead of, through the Fannie Mae. And Selma, if you would like to speak on this, do you experience that when you're talking with your customers or with the customers regarding Fannie Mae versus Ginnie and Freddie?
Well, just that process is a little bit different, and they need to understand the process, Ginnie Mae versus the Fannie Mae and Freddie Mac. And when we start testing and doing the process, they start to understand that, maybe it's a one different step, but when they get used to it, I don't see that they having any problems or as a matter of that. It's just like I said, as long as we test and then they understand, that more testing they do, the more understanding it's there why the process is different, and then it's just like maybe one step and that's it, and then they become comfortable with it.
Yeah,
that's great. Yeah. So what are some of the unique aspects of the Ginnie Mae program? Well, one unique feature is when the MERS e-registry first began, it was common for Fannie and Freddie, for example, are in the position of controller on the e-registry. But around the time that Ginnie Mae was developing or standing up its e-note program, we worked together with MERS to create a field called secured party. And so that's a relatively new field on the e-registry. And we chose it because it really better models Ginnie Mae's role as a guarantor. We don't purchase the loans the way that Fannie and Freddie do, so we're just in a slightly different position. And so being in the secured party allows us to kind of control the controller, if you will, when needed, but not have the day-to-day servicing or foreclosing or things like that the Ginnie Mae just doesn't do. We have a very small staff here. We wish we could help you or the borrower with your servicing needs, but it's just not what we do. So secured party reflects that, and it consequently, when you need to release, before you sell a loan, you'll need to request a release from Ginnie Mae, and there are other small differences that are impacted by secured party. Emily, how has that worked at Veterans? Is that been a change that you've been able to adapt to relatively well?
Yeah. So we were able to leverage a majority of processes that we already had set up for the GSEs. As you guys have mentioned, GSEs will take control and location once we commit the loans to them. However, if we decide to pool and securitize with Ginnie, we would then ask the warehouse lender to give control back to us. And then we would place our Ginnie Mae doc custodian in location and Ginnie Mae in the secured party field. And a new variation on this piece that we've actually been talking about with various warehouse lenders, and I know Lynn, you've talked to folks about it as well. Sorry, fumbling my words a little bit. Would be that we would have the warehouse lender actually place the doc custodian in the location field, and then they would place Ginnie Mae in secured party, and then place us in control to give them a little bit more control on that last step and help them feel more comfortable there. So we'll most likely be testing those processes with you soon.
That's great. Yeah, that was part of the MERS 19 rollout. I've had that conversation with a lot of warehouse lenders myself. If you are looking for more transparency into, the final delivery or the final execution of your loan, the warehouse lender does have that ability now through, Simon knows too. I think the originals implemented that technology, so the warehouse lender can directly place a loan to Ginnie Mae if that brings added comfort. But we haven't seen anyone use that, so they're already comfortable. I'm glad to hear it.
So just to expand on, we've talked about control and location and secured party and everything like that. These are positions that, in essence, are held on the MERS registry, right? And there's two aspects to them. One is providing a legal framework, right? Like who is truly in control of this asset, right? Who has, in essence, possession of it, right? Which is a little different on location because that's just where it's stored, but who actually, physically holds it. And the same with secured party, right? We're trying to put a framework in there that allows sort of the legal structure to work. There are other positions, within the MERSI registry that the vaults connect to and everything like that are more about usability, right? So who should have access to be able to perform a certain action and things like that. And so I think it's interesting to hear folks think about the legality of it and then also the operations of it. Like, how do I use this vault?
And I'll just touch on the legality of it just for a second, because I think that's also a question I get a lot. You and I have been doing this for a long time, and as has Fannie and Freddie. And so we know that e-notes are fully legal. They trade the same. They're originated the same. We pool them into standard pool types. So there's a lot of ways in which e-notes are identical to paper notes. But there are people who still haven't heard that. And so there is case law out there. The e-notes have gone through the court system. They have been foreclosed upon. They've really, we've run the gamut. And so I think, it's important to emphasize that legality has been tested and found strong.
And just on that, and this is not in mortgage specifically, but, there's lots of other electronic transactions that occur right across other asset classes. And we've had rating agencies not only say that they're the same, but they're actually credit positive to the transaction as well, right? So I talk to people, and we talk about, hey, when will it ever be treated the same? I'm like, when will it ever be treated better, right? That's really where it should be. So we'll see what happens.
That's great information to add to the other benefits, right? Anna, how about you? How are you seeing the role of the e-custodian in our digital collateral program versus other e-note programs that you manage?
Yeah, our role is different sometimes depending on the relationship with the client. So what they're engaging us to do. So with Ginnie Mae, we are always the custodian for Ginnie Mae e-issuers, but with Fannie and Freddie, we may just be a delegate for transfer. We may not be involved at all. But so what that means for us is that the processes are different. The processes are definitely different for the GSEs and for Ginnie Mae, and but that's not anything new for us because paper processes are different. So we just make sure we have good documentation in place and we know what those processes are and what our obligations are, and make sure we're performing the role that we're engaged to do.
That's a great point. When we started the Ginnie Mae Digital Collateral Program, we very much leveraged our existing paper process as well, because we wanted people to be able to benefit from, as you've benefited from, knowing what the structure of the program would be. So to the extent that, all Ginnie Mae document custodians and all Ginnie Mae e-issuers are already Ginnie Mae issuers. They're already, you can't get into our digital collateral program alone. You have to have that paper experience. So we thought that we would leverage that. And I think, and of course, you all are leveraging the Fannie and Freddie e-note processes as well. So hopefully, if you marry those two, you've already got all the experience you need, right?
Yep, definitely.
Great. Any tips for managing your organization's e-issuance authority. And I'll just explain what e-issuance authority is really quickly. We want to be sure that all of our e-issuers have room to grow. And I think there was some misunderstanding at the beginning of our program that maybe that was a cap of some sort. We have not capped growth in our program. We have no interest in doing that. We want it to grow. We want the most issuance we can get. But we do need to track it so that we can ensure that we have enough room in our vault to keep you all in business and to keep that growth going. And so we just like to hear from our issuers. What do you see for yourself in the next 6 months? Is your issuance growing? Has that been a challenge for you, or how has that experience been in managing that?
It hasn't been a challenge for us at all. So we set up a report that refreshes daily with new e-issuance every single day, and I can just track that, and it counts down for me. Am I getting close to zero? Time to reach out to Lynn. But I think the key there really is talking with you and your team on what our plan is for scaling and what that's going to look like you said, for the next 6 months, which is what we did last year when we were scaling. And that allows you guys to better anticipate and respond when we are reaching out with needs. But it's never been an issue. You've always responded quickly and given us exactly what we needed.
Great. That's good to hear. We want everyone to find that usability. Sure.
Can you just say that again? There's no cap.
Yes,
right?
I am going to say that again.
Because we certainly have heard, I think at the beginning stages, right? And it was a pilot and everything like that. But I think that rumor still exists, right? In that, there's a cap, I've got to give a number, and that's all of them approved for. But it is so important to realize that's really just for you to be able to manage, what's coming forward. So I don't know, I'm probably going to slice this part of the presentation and make sure I send it to the people who keep telling me there's a cap, Simon, there's a cap.
I've had e-issuers call me and say, we're not quite ready to securitize e-notes, but we just want a waiver for the cap. And I'm like, no, there's no cap. I promise. It really, Ginnie Mae has commitment authority, but it's separate from that, and it doesn't operate the same. It's really a tracking mechanism for us, just to be sure. Sometimes the government procurement process can take some time, and so we just want to be sure that we are procuring that space in the e-vault so that we don't hamper your growth. And so the more e-issuers come to me and tell me what their anticipated growth is, the quicker and easier I can approve that re-up of commitment authority. And if you don't think the amount I've given you is enough, it's an email. You ask me and I increase it. Unless you've got some kind of really disastrous financial situation on your hands, or you're otherwise engaged in enforcement actions with Ginnie Mae, you're not going to have a problem. We're absolutely there to make this as easy as possible for you. No cap.
I can. When we were first looking at your digital program,
Yeah.
I think that we did have a conversation. So I have a lot of empathy. We were like, oh my gosh, there's a cap, because as an issuer, you invest in the technology, you're investing in the training. And so the first thing that comes to your mind is, well, I don't want to invest if I'm going to be constrained. Or how do I do this? How can I be constrained? But I will. That's just another plug. I have empathy for people who that's their first reaction, but don't let that be your bottleneck, because Lynn has been great in all of that. So
thank you. So those are some of the unique aspects of the Ginnie Mae Digital Collateral Program, and I'll throw it out to you, Simon. Were there any particular preparations that eOriginal as an eVault provider had to make when Ginnie Mae launched Digital Collateral? Any enhancements, or were you sort of able to leverage your Fannie Freddie experience?
We were able to leverage. I think a key thing is the connectivity to MERS, right? Making sure that is invested in, and we've heard before about that. That's an important piece for ICE to continue to invest in that technology. Also around truly making it seamless for the different eVault providers to talk to each other, right? Because there was a comment before, right? There is not just a single vault, right, that everyone must choose, right? Everyone has the option. And what it is really on is the different providers to make sure that we can work with each other. And so, we've done a lot of work along with the vault providers to make sure that it is, really very seamless.
That's great. Eva, I'll throw it back to you. How did you all, as a warehouse lender, prepare to participate in our digital collateral program?
How did we prepare? Oh man,
you can say I didn't have to prepare. It was so easy.
It was easy actually once we started moving through the process and everything. It was all new to us obviously at first, but Soma, myself, there were a few other people involved, and once we started going through the initial, working through the files and sending the e-notes and testing our own process, then it became easier as we moved along. It didn't take us very long to pick it up, though. It came almost naturally for us to do this Ginnie Mae process. With Selma sending notes, I mean, it just very easy to do. I don't know, there's not another way to say it. It's just once you're into it and you're using it, it should become very easy.
Great. Well, we'll stick with you on this question, and then I'll throw it out to the other folks. Looking back on your onboarding process, on your preparations, were there any sort of lessons learned that you wish you had known? I wish I had known X.
Oh, yeah. I was going to say, we're dealing with a lot of different things going on. A lot of moving parts. When we first started, we were trying to educate our customers. I think one of our big things was we hadn't had really a platform. We hadn't been doing any testing really until we had our first customer come in and say, now we're ready to do Ginnie. If we had known what the requirements were sooner, as far as what we were going to put our customers, it just was easier. Now we know, we're like, this is going to take 5 test documents. It's going to, you have to set up your piece with Ginnie, not us, with Ginnie, things like that. Instead of, our customers kept coming to us to set everything up. And that became, kind of cumbersome to them, because they're like, well, you're our warehouse bank. Why are you not doing that for us? But now we've gotten ahead of that now. It's like, no, you go directly to. So, the one thing we need to make sure our customers understand, they should be setting this up with Ginnie Mae first prior to ever even coming to us, because we can say, yes, it is in your contract. You can do e-notes. But if you want to do Ginnie Mae e-notes, there's a little bit different process for that. And so we've become more educated on what Ginnie Mae, what your requirements are, and that we're able to pass that information along a lot easier and get our customers to understand, oh, I can't just go to you as the warehouse bank. I actually have to go back and to Ginnie Mae and do some additional paperwork, contracts, things like that, and get approved to do Ginnie Mae e-notes. So, those are the things. That's the one thing. It's like, oh, we now know they have to go to you first. I mean, they can't just come to us, and they have to work with you and your platform.
That's great. And, we really appreciate you deputizing for us and spreading the word. We've had some very productive conversations with Fannie Mae. When they talk to their customers, they will educate them sometimes on Ginnie Mae procedures. We worked with MERS. We have some co-educational pieces where MERS will hand out, here's the Ginnie Mae process. So we really appreciate the work you all are doing to spread the word about Ginnie Mae and eOriginal as well. All the work you're doing to spread the word about our unique program and how people can get involved. What about you, Emily and Natasha? What did you wish? What were your lessons learned? What did you wish you had known?
From my perspective, in the initiative, at first I thought the technology piece was going to be the piece that we needed to overcome, and that's not true. If you pick a good partner who understands what they're doing and has been in this space, that is going to be the easiest component. So don't let the technology get in your way. Pick a good partner who understands the space. Really dig deep, just not on the technology, but their knowledge in the space. Their knowledge in the space is going to be a huge beneficial to yourself too. And eOriginal has been a great partner for all of that for us. So then what I would lean more up front is, and I think several people have already talked about it, is understand what your partners that you leverage today can and cannot do. I know Emily has a whole checklist and her team kind of goes through everything, and be open to those conversations, positively influence those conversations. If they say no, it's understandable. It's for a reason. Have empathy for that, but kind of dig deeper and understand why, because we might have creative ways for them to feel safer just because we've seen other things or work with other partners who are more comfortable in this space. But
Anna, how about you? What do you wish you would know?
I think for me, I overcomplicated it in the beginning. I overthought what it truly was, and in the end, after digging in and learning about everything about eNotes and how they're moving and how it connects to MERS and the eVaults and the different eVaults involved and the different partners, it's really all the same thing. We're providing the same service to our clients. It's the same thing. It's just a digital way. So overcomplicating it created challenges, but it was good because it made you dig in and ask questions that you might not have otherwise.
I think the fact that you did your homework paid off, because you're a superstar performer in our program. So we do appreciate that attention to detail. Were there any internal processes or controls that your organization utilizes to help it successfully participate in our program, or any recommendations from eOriginal on ways technology can be leveraged in this regard?
So education and testing. We'll come back to that again.
Say it enough.
You can't. Look, even the number of tests that you need to do is just a drop relative to what actually occurs in the real life, right? Because every note is different in some way, right? Every sort of transaction is, but it gives you that level of confidence, right? I mean, we're now at almost 2 million eNotes being done, right? So in the last 4.5 years, there's about 1.5 million of them, right, that have been done. Now, what did it take? It took 14 years to get to the first 300,000, right? So we're definitely, moving up there. Still got a long way to go, right? But as an industry now, we've really got to see every sort of variant, right, out there. And so, again, educate yourself, test, and talk to folks, right? It isn't, as you said, it's not as complicated as, people might imagine.
Yeah, we have those 5 test transactions, and a lot of people do try to send me the same borrower information for all 5. And I'm like, no. 5 unique eNotes for your test transactions, because at the end of the day, you're going to be doing a whole lot more than 5 when you start going live with this, right? Right? Oh, yeah. Anything extra from you all on that? Okay. Well, talking a little bit about eNote adoption and the future, we all like to talk about what are the obstacles to more adoption, and I think we've covered that a little bit. Like it's just that education piece with individual partners. Have you seen any obstacles pushed aside, out of the way? Certainly COVID-19 was, while awful, it spurred a lot of development in this space. We see a lot more states adopting RON laws. We see a lot more, just flexibility in people realizing they can do these things from home, and states getting behind that. Have you seen any obstacles eroded along the way?
So COVID was interesting, right? I mean, on many levels. But for e-adoption, I think it hit us so hard. It hit the industry, and for the folks who were actually prepared, it made business easier for them, right? So the folks who weren't, they had to find all of these other creative ways. So, hopefully COVID is behind us, and all of the horrible parts of that, right? But it shows that the world is in constant change. You can't predict everything. And the digital gives you that greater opportunity, right? So I think the mindset for people around that has changed, somewhat, right? I'm going to get ahead of the curve rather than sort of, sit behind. Certainly it's interesting about, the RON adoption throughout the states and maybe at a federal level as well would be very nice to see. Settlement agents, I think. You're in a purchase sort of, so many people are in purchase now. But, trying to find a way that really works with them, right? And again, for those folks, some of them are investing in technology, some of them are not. But even if they're not investing, it's still possible for them to be involved in an e-close. So I think getting that out in education as well is important.
Do you need to go all in on e-notes, on e-closing, or is there still benefit for people who are just starting out with the e-signatures on some of the other less, I won't call them lesser documents, but not the note?
I can take it from just our lens and our perspective. I think it just depends what your why is. Are you looking for the operational efficiencies? Are you looking to cut costs somewhere? Are you looking for that customer experience? I think starting with your why, that'll dictate like where you start. So for us being customer focused, it was really important that our loan teams were comfortable with the process before we added in the e-note and messed that up in any way. So like we wanted to make sure that our process was streamlined and that our loan team could support, because our loan team members don't sit at the closing table, so they weren't used to having those conversations, right? The agents were there. We aren't represented at the closing table, so that was important for us in particular. But I've seen all different flavors, and I don't think that there's a wrong way. Just follow your why and stick to that, and you'll see the outcome that you want to see.
That's great. What about you, Anna, from the custodial perspective? What about the final documents? I know a lot of times you all just scan the paper documents in, so you're working with kind of the images anyway, but do you see a benefit when documents are executed electronically?
Definitely. Like we said earlier, there's obviously a lot of different opportunities for efficiencies and automation and reduced risk, of course. But with the final docs, so not talking about the e-note, but the final docs that go hand in hand with the e-notes, when we receive them, even if we receive them in paper form, we do digitize them. So we have digital images of the full collateral package. And so it does help if an issuer is sending us the documents digitally, we don't need those paper copies. So it probably reduces on shipping costs, like these guys said. It probably helps, storage. Yeah, exactly. And honestly, it's a much easier, more efficient process to get everything digitally, if allowed.
Well, that's great. Of course, we did see a lot of gain, as we said, in COVID, particularly with the RON laws, but we didn't really see the same gains with adoption overall. I think we're kind of about 6% nationally with e-notes, although North Carolina being that outlier with the 9% because of their ground level efforts. Why do you think that is? What do you think it might take to increase adoption? Does anyone have a theory?
An attitude of just do it.
Yes.
Don't be scared to
do
it.
It's, yeah. You made a comment before, like all in, and when you first said it, I was like, oh, hold on. All in, that everything has to be digital, right? I think that is a tough ask, right? So it sort of goes back to the why. It's okay to start with hybrid. It's okay to start with a note. It's okay, to have this sort of hybrid model. It gets you in the game, right? Because you still get, you get the client experience, but you still get the operations, right? If every document is being, if those documents have been tagged and signed, that those documents have been signed appropriately, right? You can't finish the package until every, document has been signed appropriately. So I think it is, it's okay just to start, right? But don't wait for nirvana, because it doesn't exist.
Yeah, that's right. Don't wait for the stars to align where you can go to a full process. Start with what you know, start with the low-hanging fruit, right?
I think that the pandemic was interesting. You did have like the emergency RON laws go into effect for the states. I think that really we were kind of concerned about title companies being the last to adopt, but I think that like really propelled the title companies to feel more comfortable with it. That technology's been out there for a while. There's e-notaries that have been out there. So they got really familiar with that part of the technology. Now it's kind of on the lenders to really start building out the e-note process. I think that during the pandemic, there weren't enough lenders who offered the e-note component of it. And so some people were just using the e-notarization component during the pandemic. So now it's really up to the lenders to really start to push adoption and really kind of help like daisy chain the other partners downstream. I think that you're gonna see that right now for customers, it's a delighter when you can offer this for them, but it's gonna quickly shift to an expectation. Like they're gonna want it. More and more people are using it. So as they refinance or purchase again, they're going to expect the same experience. So just advice, like don't get caught being a provider that can't provide an experience that people want. So get ahead of the game and get in there before you're forced to kind of speed your way through it.
That's great advice. Okay, Eva, for our last question, we'll throw it out to you first. If I could change one thing about Ginnie Mae's digital collateral program, it would be.
You know what? I'm going to throw that over to Selma to see how what she has as far as the testing piece. Because I'm more in the legal side, managing the contracts. So working with the customer, if there was one thing, Selma, what do you think it would be that you would change?
That's a tough question since I got used to it so much with the Ginnie Mae and testing, but I don't see nothing. I really, I think it's a very good platform and just, needs to be more, education and testing, and I don't think I will change anything.
Thank you. Simon, you aren't really a direct program participant, but we'll give you a chance to answer.
Can you remove the cap?
No cap. I promise.
You've already removed it.
Call me.
Okay.
We'll talk. Emily?
Sure. I think we would probably ask for removing of the overlays regarding commingling wet and e-notes, and then also being able to put e-notes into PIT pools with our co-issue partners, so they can also purchase through that landscape as well.
Fantastic. Yeah, those are both innovations that we have on our to-do list. Right now, we started with digital-only pools because we wanted to ensure that you had good liquidity in those pools. We didn't know how many pilot lenders we would have. We had 12. That was a good number. I think we did have some good trading potential even in that number, but now we've doubled that number and we're on track to increase it even further. We've gotten some of Ginnie Mae's biggest buyers into the program, and so I think that liquidity piece is really shaping up. I think you're going to see that, and we get SFPDM adoption behind us, and we're on the way to commingling. And we have some good systems changes in terms of transfers as well that are going to allow us to enable PIT in e-notes as well. So we do hear you, and we're on it.
Awesome. We're excited for it.
Anna?
I actually was not going to recommend anything for the custodian because the most common feedback I get is the commingled pools for the issuers. So that is actually what I was going to say is commingled pools, I think, is what I hear most is what people are looking to have changed.
Perfect. Well, I'm glad we can help. Thank you all so much for joining us today, and to our panelists and to our wonderful online panelists as well. We love that warehouse perspective. I think you've helped demystify something that I get a lot of questions about, and we're ready to take questions if anyone has. We have some online questions.
Yes, we have a few questions and one comment. This might be helpful for the audience. When learning about eNotes and how they are shared among trading partners, it helps to understand there will be multiple copies of eNotes in play. eVaults don't transfer an eNote to another eVault. eVaults send a copy of an eNote to other vaults. Once that is understood, the role of the MERS eRegistry and eVaults becomes clearer.
That's a really interesting comment. Yeah, I think for people who are kind of joining us at the beginning of the discussion, the e-registry is, as Simon was discussing, it's the legal record. Because you have no paper to sort of show up in court with, you look to the e-registry as the record of which e-note is the authoritative copy or the original, if you will. However, which copy of the e-note is the authoritative copy can change. At Ginnie Mae, we require that you deliver the e-note to our custodian, or Ginnie Mae approved custodian. We also require a copy delivered to Ginnie Mae. And I think sometimes at the very beginning, people forget that. But the reason is because ultimately that provides us with some protection that we have a copy of all Ginnie Mae e-notes in our vault should you do anything terribly naughty and we need to default you, which doesn't happen often, of course. But we do have that extra surety from that. And you can change who has the authoritative copy. And it's also important to know that all eNotes are wrapped sort of in this smart doc technology, which provides a tamper evidence seal. And so you can't just go in and change an eNote.
Yeah, so how we do it is we refer to as really an authentic copy, right? And that authentic copy can always be checked against the MERS registry to say, hey, is this exactly what the original looked like? But as you said, just because you have an authentic copy doesn't make it the authoritative copy. The authoritative copy is determined in the MERS registry, and in essence, that's a pointer to whichever of the 2s to the 10s to the hundreds of copies, authentic copies that might be out there, which one is actually the authoritative copy.
Yeah. Great point, commenter. Thank you.
All right, next we have, where do you store your final documents? What is the system of record?
Well, so we sort of covered that a little bit with the e-registry and pointing to where almost all of our loan packages right now are hybrid in the sense that to qualify as an e-mortgage in the Ginnie Mae Digital Collateral Program, you do have to have the note be E. So the e-note will be stored in an e-vault, and our issuers and our custodians and Ginnie Mae itself, we all have e-vaults. However, there are a lot of paper documents, trailing documents that go along with that. Those are stored at the custodian, much in the way they were in the traditional Ginnie Mae program. And they have a mechanism to make sure that those are all tied in together. So if we went and said, I need Bob Smith's loan file, they would be able to marry those paper documents and the e-documents as well.
To chime in on this one, from the lender perspective for eNotes, we digitally send to the doc custodian, and we're actually holding on to those final docs in our own vault in case they're ever needed as a backup if the digital copy disappears or anything like that.
Fantastic. So we have a lot of redundancy in this system, which helps with security as well.
All right. This panel has already embraced eNotes and digital mortgage and is seeing the benefits unfold as they scale. Does this panel currently see many other lenders actively working on implementing eNotes, or is that still wishful thinking in the industry? In short, are we anywhere in sight of the eNote tipping point?
You want to go?
Yeah, so no, there's lots of people doing it, right? It is definitely a robust ecosystem, right? Not only of the participants in the process of the originators, the warehouse lenders, the custodians, the investors, Ginnie, etc. Did I miss someone? Maybe I did. But also of the technology providers as well. And so, each one of those technology providers sort of understand what is happening inside of their space. But actually, one good way to sort of see the growth of the industry is to go to the Mersey registry. They actually have a list of all of the different participants, right, across that different spectrum to see that growth. And so we've been tracking that as well. And it's been nice to see. We're probably seeing a greater percentage come on than we're seeing in volume, right? But I think that's just because of timing, right? You've got to ramp that up. And so that's pretty exciting, because if you think about the volume that was happening with this X, and now you're going to this Y, I think there's a lot out there.
That's a great point. We do see a larger volume from our experienced e-issuers, but I get new applications for e-issuers every month. And in fact, we just approved a new e-issuer yesterday. Welcome, Lakeview. So we're very much still seeing new applications. We're very much seeing new approvals. And we also, when we started the program, we asked that our pilot participants have Fannie Freddie experience before they came to us, simply because, again, staffing issues, they have a little more, more folks to hold your hand over there and help you get through that implementation process. But we don't require that any longer. We are definitely accepting and looking at people and currently helping applicants who don't have Fannie and Freddie experience. We work with MERS a little more closely. So we're seeing people who have not entered this space. We're not just duplicating the Fannie and Freddie lists. We're seeing people who are bringing whose main business is Ginnie Mae, wanting to get into this space, and we're helping them do it.
All right, this is our last online question. Does the panel believe that better investor pricing for loans with e-notes would accelerate adoption?
I've been told many times that commingling will definitely help pricing. And you can understand why, because if the volume of e-notes is low, and you only have 2 or 3 coming in the door, but you don't want to stick them in a drawer and keep them on the warehouse line, you want to be able to pull that right away. And so you can understand why commingling would help in the pricing. Natasha?
I would say too, it's not just one party that's going to tip it over. It's going to take all of us. So don't look at just the issuer to be the one to tip it over, or the dock custodian or the warehouse lines. Everybody should be kind of working towards this way, and that's what's going to tip the volume over. So I wouldn't necessarily pin it on one part of the party. We're all in it together. But I do think a lot of people do look at the lenders, they need to do it. Once they do it, then I'll get into the space more. Or, okay, well, I got to wait for the investor. Once they get more comfortable, then I, as a lender, will start to get more comfortable. So just dip your toes in. You're not going to be committed to your whole portfolio going into e-notes. Learn, explore, and it'll just take us all.
And start small. That's the most important thing I can recommend. Start small and then scale up. Don't just open the floodgates.
Yeah, I had one issuer that said they did their employees' loans. They did their employees' personal loans and just worked on funding those before they came to Ginnie Mae for securitization. So that's a lot of testing. We like that.
The short answer to that question is, of course. Of course it would, right? But the slightly longer one is there is better pricing by being right? The speed at which you can sell and securitize and get into the right pool and everything like that is there. So I think, people should step back a little bit from that and just say, hey, calculate the benefit, beyond just that. But if someone wanted to do that, I'm sure, whether it's a government entity or whether it's a private investor, I think, there's certainly an opportunity for them to drive behavior.
Any more questions?
All right. Do we have any questions from the audience?
There are seasoned pros in the audience here live.
And Simon, you did forget. So I'm curious, our members also pledge Ginnie Mae securities as collateral, and we look at a Bloomberg screen to determine eligibility. And I was just curious, how are the e-note pools coded? How can we tell how many, and it'll make more of a difference when it's commingled, I understand, but I'm just curious how they're coded right now.
We don't really distinguish actually in trading. There's just not a need to. Like I said, they're originated the same. They're placed into the same pool types in Ginnie Mae. And so Wall Street just doesn't make a huge distinction.
That's good.
That is good, isn't it? Right. But that's what we were talking about before, right? Like, how do you value them at par versus, negative? That's it's good to share.
All right. Any other questions? Any last questions? All right. Thank you, everyone.
I'd like to thank our speakers, our panelists, our Ginnie Mae staff, especially Carmelo Bramante, who has been the lead on this project since day one. I want to thank our comms team, and most importantly, our in-person, who I'm thanking right now, and our live stream participants for staying with us for the entire day. As we have heard during today's event, digital technologies are transforming the way that mortgages are originated, processed, closed, and serviced. These technologies are making the mortgage process more efficient, convenient, and accessible for both borrowers and lenders alike. In addition, digital and innovation is improving the accuracy and transparency of the mortgage process, which means better outcomes for our borrowers. As the mortgage industry continues to evolve, it is important for originators to stay ahead of the curve. And we hope that this program has been helpful in that regard. And hopefully by doing that, they will improve their efficiencies, reduce their costs, and provide a better experience for their borrowers. Thanks again for taking the time to attend our summit. Have a great rest of your afternoon and stay safe. Thank you.